by introducing Mr. Thembani Pukula, who's the chairperson of the Energy Regulator and a member of the Piped Gas Subcommittee. Morning, Mr. Pukula.
Morning, Chair, and morning, everyone. Thank you.
Thank you, Mr. Pukula. I would like to then introduce Ms. Zandile Mpungose, who is the Deputy Chairperson of the Energy Regulator and the member of the Piped Gas Subcommittee. Morning, Ms. Mpungose.
Thank you very much, Chair. Good morning, everyone.
Thank you very much. All right, moving on to Mr. Nhlanhla Gumede, who is the full-time regulator member, primarily responsible for electricity, and he's also the member of the Piped Gas Subcommittee. Mr. Gumede is not Lebogang Palati. Mr. Gumede, please deactivate Lebogang.
Good morning, Chairperson. A bit fluish, but yeah, thank you. Good morning.
Good morning. Thank you very much. Going on, I would like to then introduce Ms. Advocate Nomalanga Sithole, who is the Chief Executive Officer of NERSA, as well as the member of the Piped Gas Subcommittee. Advocate Sithole.
Good morning, Chairperson, and everyone on the platform. I'm also having a bit of a flu. Apologies for that.
Thank you very much.
Thanks.
Yes, thank you. The next one, I would like to then introduce Muzuvukile Mkhize, who is the full-time regulator member, primarily responsible for petroleum pipelines and the member of the Piped Gas Subcommittee. Mr. Mkhize.
Good morning, Chairperson, and good morning to all the attendees. Thank you.
Right, thank you very much. Ladies and gentlemen, good morning, everyone on the platform. And we have about 3 matters to hear today. All of the matters are applications that were brought by Sasol Gas. The first application that we are going to hear is the application for a maximum price for the financial year starting July 2022 until June 2023, that is FY23. So that is the first application that we're going to hear today. The second one is the application for the maximum price starting from July 2023 up until June 2024. That is in terms of the new methodology. That is the second application. And the third application is again from Sasol Gas, and that is for the application for the transmission tariff for all of the gas pipelines owned by Sasol to transport gas in South Africa, and that is for 2 years, starting from July 2023. I would like, therefore, to welcome you in this hearing, and as indicated, that this hearing I will be assisted by the members of the Energy Regulator, and the hearing itself was published in various newspapers, including the Star, Cape Times, Mercury, Business Day, and Bleed. So those are the newspapers where the applications were advertised. The applications were also posted on the NERSA website, and this hearing is held in accordance with the Energy Regulator Act, in which affected parties are given an opportunity to submit their views and present relevant facts and evidence to the Energy Regulator in order to assist the Energy Regulator to arrive at a well-informed decision. It must also be emphasized at this stage that we have already given the parties an opportunity to submit their comments on these 3 applications in writing, and this is the second opportunity that we are giving to stakeholders. This hearing is governed by the NERSA rules on public hearings, which I will summarize as follows: that all parties will be required to make their presentations under oath. The public hearing will be set down according to 3 applications submitted by Sasol, and the presenters have been allocated times according to the applications they will be making presentations on. That is, the presenters that requested to present today is Sasol Gas, who's allocated as an applicant there so that they deal with all the issues, given 15 minutes. Iguasa is allocated 35 minutes. Springlight gas, 15 minutes. If the applicants believe that they need a little bit more time, the applicants the presenters can request that additional time. Then, as the members of the panel, we can decide how much time we'll grant to the presenter to finish off the presentation. Only members of the panel may ask questions to the presenters. However, the members of the public may forward their questions to eliezer.dlamini@nersa.org.za, and the panel will decide how to deal with those questions that the members of the public would like us to pose to the presenters. Should presenters believe that there is information that they consider to be confidential, please indicate that to the panel. Then we can decide whether we would like to clear the room and hear that confidential information, being the panel as well as the staff of NERSA only. The recording of this hearing will be done through our recording system and will also be a live audio streaming on NERSA's Twitter page. This will be the official record of these proceedings. The House rules then are as follows. Please switch off your cell phones or put them on silent mode. Please ensure that your mic is off if you are not speaking, and your video is also switched off at all times, unless it is the person that is presenting. Please use the chat responsibly to contribute to a meaningful discussion throughout the hearing. Today's presenters, from Sasol, we have Mr. JP Menkis. We also have Ms. Pindile Masangane. We also have Brenda Bajanath, and we have Mr. Rudy Easterman, as well as Mr. Christo Rooks. For Iguasa, we have Mr. Yako Human, who will be representing Iguasa, and for SLG, we have Mr. Mzi Chokolo, who is representing SLG. Now we want to go straight to the first presenter, being the applicant in this matter. We're starting with you, Mr. Menkis. I'm not sure if I must allow all of the members of the team at this point in time to be sworn in, or they will come at the time that we ask the questions, or are you going to take the presentation by yourself and then they'll come in during the question stage?
Yeah. Madam Chair, good morning, and thank you for the opportunity that we have to present on the applications in this public hearing. The way that our presentation is structured is that the intention is, because there are certain matters that relates to both of the pricing applications, we've got a single presentation that deals with all three of the applications that are before the regulator, and the different team members will be dealing with different parts of that application, and we will, as we go through the presentation, we will then change between the different presenters. So from a let's call it a housekeeping point of view, it would probably best to do the affirmation of all the presenters at the outset. I will then start with the introduction, and we will then basically deal with the presentation in the sequence of the different presenters. And as I've indicated, two further points just to clarify. In the presentation that we are making this morning, we've not included any of the confidential information that have been submitted to NERSA, that obviously have been submitted as part of the application itself, as well as our subsequent written submissions that were made to the regulator. So from our point of view, there wouldn't be any requirement during the presentation to deal with any confidential information. And then the
Mr. Menkis, can I start by swearing you in, and then you can clarify the presentation, the structure of your presentation, how you would like to proceed. All right. Do you have any objection in taking the oath?
No, I don't.
All right. Thank you very much. May you please raise your right hand and affirm the following? All right. Do you solemnly declare that the evidence you are going to give this panel is the truth and the whole truth?
I do.
Thank you very much. For the record, may you please state your name, your organization, and your designation at Sasol?
Right. My name is JP Mankies, and I am the Vice President Legal for Energy Business at Sasol, and as in that capacity, the Sasol Gas business is part of my portfolio.
All right. Thank you. May I then have the next person from Sasol, please?
Yeah.
Good morning. Thank you. Good morning, Ms. Pindile Masangane. All right. Good morning, ma'am. Ma'am, do you have any objections in taking the oath?
I have no objection, ma'am. Good morning and good morning.
Okay, thank you. May you please raise your right hand and affirm the following? I can't actually see it. All right. Thank you. Do you solemnly declare that the evidence you are going to give to this panel is the truth and the whole truth?
Yes, I do.
Thank you very much. May you please state your name, your designation at Sasol, please, for the record?
The record, my name is Pindile Masangane. I am the Vice President for Regulation and...
We couldn't hear you. The last part, we couldn't hear.
My name is Pindile Masangane. I'm the Vice President for Regulation and Policy at Sasol.
Thank you very much, ma'am. All right, shall we then go to the next person from Sasol?
Good morning, Madam Chair. It's Brenda Bejanath.
Okay. Hi, Brenda. How are you doing?
Very good, very good.
All right. May you please raise your right hand? Do you solemnly declare that the evidence you're going to provide to this panel is the truth and the whole truth?
I do.
Thank you very much. May you please state your full name and your designation at Sasol?
It's Brenda Bejanath. I'm the CFO for the Energy Business Unit spanning Southern Africa.
Thank you very much. The next one, please. Good morning, Mr. Easterman.
Good morning, Madam Chair. Rudy Easterman.
Thank you. All right. Do you have any objection in taking the oath?
I do not.
All right. May you please raise your right hand and affirm the following. Do you solemnly declare that the evidence you are going to provide to this panel today is the truth and the whole truth?
I do.
Okay. May you please state your full name and your designation at Sasol?
Rudy Easterman. I'm the head of regulation for markets.
All right. Is that all? Do you have any other person?
Lastly, we've got Mr. Christo Roo. He's from FTI Consultants, Madam Chair.
Okay. All right. Is the economic firm FTI, by the way? Is that the economic firm? Okay. All right. Mr. Roo, do you have any objection in taking the oath? I can't hear you. Your mic is off.
You're on mute.
I don't have an objection, Madam Chair.
All right. May you please raise your right hand? I can't see it. May you step backwards? Okay. Do you solemnly declare that the evidence you are going to give to this panel today is the truth and the whole truth?
I do.
Okay. May you please state your name, your company, and your designation?
Christo Roo, FTI Consulting, Senior Managing Director looking after energy matters at FTI Consulting.
Okay, thank you very much. May you please then start with your presentation, Sasol. Sasol, we've got a program before us. May I just direct you how you're going to provide, do your presentation? We want to start off with the FY 2023. So if you could make sure that the team, those that are going to present, we're going to focus on the FY 2023 first, and then followed by FY 2024.
Madam Chair, if just at the outset, if I see there's a hand that's been raised by somebody, I don't know. But Madam Chair, just at the outset, we wanted to, as I indicated earlier, From a structural point of view, because there are overlapping issues between the two pricing applications, we've prepared the presentation as a single presentation that basically spans all three of the applications. And insofar as the transmission tariff application is concerned, there is no particular content in the presentation aside from confirming the requested and tariffs that Sasol applies for approval in the application. So there's no specific content regarding that application that we will be highlighting during the presentation. And our presentation will deal with the two maximum gas price applications, namely the FY24 application and the FY23 application. And with your indulgence, Madam Chair, if you would allow us to present the presentation in that fashion, and then obviously with regards to the questions and also dealing with the responses to that, the questions will then be differentiated between the two different applications. Is that in order, Madam Chair?
Chair, you are on mute.
Thank you, Mr. Pokula. That will be in order, Mr. Menkis, but it is important for the energy regulator to also just make sure that the application are not necessarily consolidated. And also that the facts, and you know very well the process of consolidation on its own, even if the matters are from the same applicant, it becomes a legal procedure, and we would not want to get into issues of consolidating the matters, especially because there must be facts and evidence that is specific to the particular application. And also, if one requests a record of a particular application to verify the facts, that the record must speak to that particular application. So that is why I'm saying that, can you please try and focus on the FY 2023 for purposes of making sure that the proceedings will be specifically for that particular application and the facts and evidence pertaining to that.
Yes, Madam Chair, the point you made is well made and understood. The applications are three separate applications. There is no intent from the applicant side for any consolidation of the applications, and we also understand that the decisions that NERSA will be taking in regard to each of these applications will be a separate decision in respect of each of the applications. I think from a oops, there we go. So from a content point of view, the topics that we intend to deal with in our presentation is as follows, Madam Chair. Firstly, there will be a general introduction which Ms. Byneth will be presenting with regards to gas in the broader context, both for South Africa and Sasol. We will then confirm the three different applications and the basis on which each of those applications are put before the regulator. And then in respect of the particular price applications, we will then make specific submissions in support of those applications. And we will clarify during the presentation to which of each of the applications the submission pertains, and then in conclusion we will confirm the requested approvals that Sasol is requesting from the regulator in the applications before the regulator. So Brenda, if I can hand over to you to deal then with the general introduction.
Thank you so much, JP. And Madam Chair, thank you again for the opportunity. I think at the onset, on behalf of the Sasol executive team, we really want to thank NERSA. I think we've really come a long way, particularly when we're thinking around FY24 and trying to now get finality on what the methodology would be, and really working together with us over the past 18 months to try and resolve this speedily. So our extended thanks to NERSA as well as your management team in the way that we've worked together to be able to to get to this point. So just in terms of some context setting that will really outline, the three price applications that we have, I think we all recognize that gas is actually a scarce resource globally. And particularly when we think about South Africa, we are seeing that the plateau in Mozambique is starting to decline, and hence there is going to be further investment that is going to be required to be able to extend the gas supply into South Africa beyond 2026. And at the current prices that are being proposed, whilst we acknowledge and we recognize the headway that we've made, but unfortunately, when we look at a cost-plus mechanism, I think NERSA must acknowledge that it becomes extremely difficult in order to incentivize further investment. So when we think particularly around the risk that we look at the upstream, when we look at exploration costs, development costs, those costs are actually not charged onto the customer, which effectively means that Sasol will have to bear that full cost to be able to access gas, to be able to provide it to South Africa. As an example, to date, we've actually spent $300 million. To put that into rand terms, that's 5.4 billion that we've spent since 2021 to actually extend that plateau from 2024 to 2026. No part of the 5.4 billion that I've just referenced has been passed into the customer. And hence we ask that as we progress and as we mature the methodology going forward, that NERSA also starts to take this into account to recognize the risk that is required in terms of exploration, as well as compensating them for the development to ensure that gas reaches South Africa. Another example that we'd like to provide in here is Sasol has just released its financial results last Wednesday, and you will see that through the exploration activities that we've had, we actually had to write off 3 dry wells. So that effectively means that we are looking at more wells in Mozambique where we are drilling, and if that well turns out to be dry, you actually write it off, and that number is approximating 900 million that we've actually then written off because those wells were actually found to be non-economic. That again, that cost was not passed on to the customer. Our commitment remains that up until 2026, we will continue with endeavors to be able to access new gas resources, to be able to continue with our exploration activities. However, where we are finding it very difficult is that the regulatory system currently does not support or incentivize further development. And for the sake of the country, we are saying, how can we work together to find a methodology that can incentivize? The second part of it is that the NERSA team and colleagues online would have also seen that we've written down our Secunda liquid fuels assets to zero last week with the results announcement. That means we've taken a write-off of 32 billion. And the reason for taking that write-off of 32 billion is because of the significant investment that we are putting into Mozambique. That cost is flowing through into Secunda, and we don't have the corresponding revenue to be able to offset it. That is just one component of the reason, and there are many other reasons. But I think it is testament to that we are seeing that the viability of our existing assets in South Africa are also coming into question because of the regulatory regime that we are facing. When we think about future investment into South Africa, and I think it's critically important to say that as Sasol, we remain committed to the country. We remain committed to continue with investing into our assets, continuing to promote job creation, as well as uplifting of the Vaal Triangle, as well as in Mpumalanga, where we have our key operations. However, when we do not have regulatory certainty, it makes it extremely difficult to make those investment decisions. As you can imagine, every investment decision that we make takes approximately 5 years till that asset can be built, till that exploration can be confirmed, or until that development can be confirmed. As we stand today, it's extremely difficult with the board to be able to motivate those investments when we have a regulatory regime that is changing. By example, since 2013, we've had 3 different methodologies, and we acknowledge that the maximum gas price that was applied previously of 276 is extremely high. However, what we are asking for as we move forward is how do we find a more stable regulatory regime that we can adopt and we can implement that provides certainty to us as the investor, that provides certainty to our shareholders, so that we can actually make these investments in a more methodical way going forward. I also think that as we start to look at what are the new alternatives, what are the alternative sources that we can identify in the market, we are going to need to find incentives again to be able to explore what those new opportunities are. But as we stand today, the next alternative is coal, and we all know that Sasol, together with the country, has committed to reduce our emissions going forward. So if we move on to the next slide, thanks, JP. What we are seeing is that in the short to medium term, today we only have two sources of gas. One is methane-rich gas, and that gets produced out of our Secunda facility. We are, as I mentioned, now driving a very hard decarbonization agenda to support South Africa to achieve its own NDC goals. And that means we are already investing up to 25 billion over the next 5 years to be able to decarbonize. And hence gas becomes a key part of that transition as we move from coal to a low carbon source such as gas. And hence we need to make sure that we can actually retain MRG within the organization as well, so that we can decarbonize and make Secunda actually much more sustainable going forward. So that's the MRG that gets produced in Secunda. Second to that is when we look at natural gas from Mozambique. As I indicated in my opening remarks, we've extended the plateau from 2024 to 2026, and that came at a cost of 5.4 billion that was incurred by Sasol and not passed on to the customer. However, what we are seeing is post-2026, there is going to be an indication that there will not be sufficient gas to meet our current contractual needs. And hence, what we are looking at is to say, how can we look at other opportunities? But importantly is that this additional opportunity is coming at a much higher gas price. And the reason for that is as we bring in new contractors in Mozambique, as we look at what is the cost of bringing in drilling rigs, all of these costs are now starting to increase, not just due to inflation, but also due to having to bring in contractors from outside Mozambique and having to rent out equipment that is outside of Mozambique as well. So whilst we are committed to localization in that country, I think there has to be an appreciation by NERSA that these costs are starting to increase, and hence any alternative from what we have today is coming in at a significantly higher cost and will be reflected in the cost plus mechanism going forward. And as I've mentioned as well, is to re-emphasize that ongoing exploration is critically important. If we do not continue with those exploration activities, we will find ourselves in a situation where very soon, 2026, the country will start to see a decline of gas. And hence, this is also coming at a cost, and it is very unlikely, therefore, that we'll be able to extend that plateau to 2030, and we are likely to see a shortfall. So what are we doing about that? There are two things. The one is we would have seen lots of media announcements around local fines, and we are currently working with these partners to be able to understand on the technical side, how can we support, how can we use some of our own technical expertise to be able to accelerate that. However, at this point in time, that gas cannot be confirmed. As you can expect, it is still very early days. Hence, when we look also at the time frame that it takes, my reference to 5 years earlier, when we're looking at local fines, it's probably 5 to 8 years or even longer. We do not see that within the 2030 time frame we will be able to access that local gas. However, our key message is that we remain committed, and we are already engaging with the local producers that have identified these discoveries to look at how we can support them. But as of today, as I'm speaking to you, we do not have that confirmed. The next is to the 2030 period is actually to look at LNG. However, I think that we all see as well that as a result of the Russia-Ukraine crisis, LNG is coming in at a significant cost. Sasol Gas on its own cannot play a volume aggregation role. Using the law of economics, if we are able to get gas at higher volumes that we can aggregate, we will be able to get a better price. But on our own, we cannot play that aggregation role. Importantly is that when we look at current LNG prices, this is not affordable for Secunda as well as for Sasolburg. It remains as a signpost. We will continue to watch this, but importantly, it requires the country, the gas users, the biggest gas users to actually aggregate together and look at how we could find a potential solution going forward. So this remains under conversation and something that we are talking to customers about to look at how do we collectively solve the challenge that we see for South Africa to 2030 and beyond. So moving on to the next slide and just reflecting then on the cost plus mechanism. So what we are projecting as Sasol is, through my entire presentation, is that whilst we are thankful again to NERSA for bringing in a new methodology into FY24, for trying to provide some certainty on the regulatory mechanism, the cost plus methodology does not reflect the risk that we are taking and does not fully take into account the capital investment, the exploration and the development costs that we are incurring to be able to try to find new gas finds. If we look over the past 2 years, effectively our maximum gas price has been pegged and fixed at 68.39 Rand a gigajoule. If we look at where inflation has been over the past 12 months, closer to 14%, we haven't been able to pass that cost on to customers, and effectively our margins have been compromised. Our own shareholders of Sasol have had to bear the cost of that higher inflation, and we believe that we've been faced with severe prejudice from that perspective. It is therefore critically important that we can move forward such that we can ensure that there's an equal, fair playing field where risks and rewards are being adequately recognized, and that we also ensure that from a Sasol shareholder perspective as well, that they're also being compensated for the higher inflation cost that's currently being absorbed. We also see into FY23 that cost is also being kept flat again, so 2 consecutive years, and hence we've been working very closely with NERSA over the past 18 months to try and find a way forward. When we look on a global basis, we also don't believe that the price that we have is competitive. However, as at the onset, I said we do recognize that the previous methodology was yielding a price that was extremely high for the current economic environment in South Africa. And hence, what we are putting forward today for FY23 is to also look at what could the alternative be. And then for FY24, it's a straight application of the methodology that has been proposed and put forward by NERSA. So my arguments that I'm presenting here is, whilst we are asking NERSA to review the FY24 methodology to ensure that there is an equal compensation for risks and rewards, that we also recognize the exploration component that needs to be done, we have complied with the methodology as set forward for FY24. Going forward is that we will now ask JP to take us through then what are the 3 applications that we are putting forward, the basis for that, and if it's fine with you, JP, I'll hand over at this point. Thank you so much.
Yes. Madam Chair, as I indicated at the introduction, the 3 applications that we are dealing with today is then the maximum price application for FY24. And as Brenda has indicated, after a decade of the maximum gas price being determined in order to mimic competitive prices in the market, a cost-plus approach has been adopted by the regulator. And we have consistently indicated in our engagement in that process, as well as our submissions regarding the application for FY24 and 23, that Sasol does not agree that a cost-plus approach to the regulation of the maximum prices is an appropriate approach. It doesn't recognize the commodity nature of gas, and it also doesn't support the required investment required in order to grow the market going forward. However, in order to ensure that we are not stuck in the situation where the existing maximum price that was determined in FY22, the 68.39 Rand, has to continue, we've brought the application for the FY24 maximum gas price based on the cost-plus approach and methodology that NERSA has adopted earlier in the year. With regards to the FY23 maximum price application, we've followed a hybrid approach. In that space, we are putting forward a price that is appropriate for the circumstances and that can be deemed as an appropriate competitive gas price in the market. And based on the full 2023 set of data that is available, the calculation of that hybrid approach, which combines the cost plus approach contained in the 2023 maximum gas price methodology adopted by NERSA, together with an element to compensate Sasol for the alternative value dilution that's brought about by the fact that a certain volume of the gas is put in the third-party market, which could have been utilized in our own production facilities for the production of high-value alternative products. That component is then added to that cost-plus approach in the hybrid approach, and it's on that basis that we apply for the approval for a revised maximum price for FY23 in the amount of R107.43. And we also request NERSA then to approve an appropriate recovery mechanism that will allow Sasol to recover the difference between the price that was actually charged in 23 and the price approved by NERSA as an appropriate maximum price. And we will get into the detail of the basis on which this approach is put before the regulator in the latter part of the application. As I indicated also, as far as the transmission tariff application is concerned, we confirm that that application was done in accordance with the applicable tariff methodology adopted by NERSA, and we confirm the tariffs as set out in the application that was put before NERSA for approval. So in the next part of the presentation, I'm going to hand over to Rudy Histerman just to take us through some of the key elements in respect of the FY24 application. And then when that is complete, we will go to FTI in order to give us a explanation of the basis on which the calculation was done for the FY23 maximum price applied for by Sasol. So, Rudy, if I can hand over to you for the next 3 slides, please.
Thank you, JP. Madam Chair, I will not repeat, our view on the cost plus methodologies at this point. I think we've covered it reasonably. We've covered it well so far. What we would like to point out is that we followed the methodology. So this in this presentation, we are not going to dwell on the calculation of the cost, the volume weighted cost of acquisition. We will give an explanation, which Krista from FTI will do, just in terms of how the profit component that we calculated varies from how NERSA calculated it to an extent. And then there are small differences in the trading cost that we'll deal with. But I think what's very important is that since we're now having a situation where the profit is regulated, in order for the franchise, the supplier and customers to be reasonably well protected against fluctuations in the market, we believe it's critically important that we have adjustments, regular adjustments of the prices in line with changes in the acquisition costs. Just to explain how the acquisition costs are determined. Our natural gas is acquired by Sasol Gas on long-term contracts. Those contracts had an initial base price, and those base prices are then adjusted with international oil, international diesel, high sulfur fuel oil prices, and RSA and USA producer price index changes. Those changes are then or those prices are converted to from US dollar per gigajoule to South African rands and adjusted on a monthly basis. Similarly, methane-rich gas is sourced through long-term contracts. There was an initial contract of a block of volume which is adjusted with South African PPI. The second block is adjusted with Dubai oil, respectively, and then converted to exchange rates. So the proposal Sasol Gas is making is that we will provide the underlying acquisition costs and calculations to NERSA on a regular basis to enable monitoring and confirmation of the adjustments. And then the request is that we have make the underlying adjustments, as the prices are contractually determined on a quarterly basis to keep the price as closely aligned as possible to the underlying contracts. JP, we can go to the next slide. In the trading cost element, NERSA in its consultation document states that there is an indexation amount included in depreciation. We have provided that information separately and can confirm that our trading assets are treated in terms of the trading methodologies and are not trended. So we would request the regulator to take heed of that and adjust its calculation of the trading cost. In terms of unaccounted for gas, Sasol supports the treatment of this real cost by the energy regulator in terms of using a benchmark level of 1%. And we would also like to point out that the contractual limit above which transporters have to carry unaccounted for gas is 2%. So this certainly forces a level of efficiency for both the transporter and the shipper. So therefore we do support that. JP, can you move to the next one, please? After careful consideration and taking heed of the discussion document and NERSA's assessment in that discussion document, Sasol's reconsidered its opposition to the imposition of a discount for traders and for resellers and traders. We will therefore accept the imposition of a discount of 5% as set out in the methodology, the 2023 methodology, and we will then implement such a discount with the implementation of our maximum prices once approved. Can we move to the next slide, please, JP? Sorry, JP?
Yeah. No, really, I think just a point on the previous slide is that obviously that differentiated price between the maximum gas price approved by NERSA for end users and a separate discounted maximum gas price approved for traders and resellers will then apply in both cases in respect of the FY24 application as well as the FY23 application, Madam Chair. I think in the next bit of the presentation, with regards to FY23, as we've explained, the price that was determined and applied for by Sasol is determined by the utilization of a hybrid of the cost plus approach that NASA adopted earlier in the year, together with a compensation element for the value dilution suffered by Sasol as a result of the difference between the alternative value that could be derived from the gas in utilization thereof for the production of higher value products in our own facilities, as opposed to putting that gas into the third-party market. And then obviously, as Rudy has indicated earlier in the presentation, there is also a slight difference in the proposal that Sasol makes regarding the calculation of the profit element based on the EBITDA average as set out in the 2023 maximum price methodology. So to explain the basis of these two elements, I'm going to hand over to Chris Ru from FTI to take us through the explanation of these two components before we get to the last point regarding the FY23 application. Chris, can I hand over to you?
Thank you, JP. Thank you, Madam Chair. Just the next slide, please, JP. Okay, I'm not going to try, I will try and not repeat everything that has been said about alternative value dilution, but I do think it's important that everybody understands the alternative value dilution is limited to the profit component only. And it's also limited to Sasol's surplus capacity that it had in its refineries when delivering gas to the external market. So I think it is important to understand it's not at the outset that Sasol is adding an additional margin on top of the regulated margin. It is using in this application the cost plus methodology, but it then differentiates based on an alternative use of the natural gas, a higher margin, which is only attached to the gas that can be consumed as surplus in its refining capacity. Now, if we look at, so that explains what is meant by hybrid price determination approach as seen on the slide. If you look at the top end of the slide, Sasol, as it stands in FY23 actuals, prioritized the supply of of gas to the external market, and therefore external market gas has been supplied, which leaves surplus refining capacity in both of Sasol's refineries. So if you look at the product slate that comes out of the refinery or the products that is then produced at the various refineries, Sasol has two ways of making a margin out of the supply of gas. Firstly, it can supply that gas to the external market, and that is obviously in a regulated price component, or it can consume that natural gas up to the refining capacity in its own refineries, and in doing so, it then creates fuel products and chemical products. Those fuel and chemical products is then sold as a finished product into the external market, and it then, as indicated on the right-hand side, creates a higher margin. So that channel creates a higher integrated margin for Sasol as opposed to selling the gas to the external market in the gas commodity form. The alternative supply then really looks at that alternative that Sasol has, i.e. it can consume the gas sold to the external market in its refineries first. So that's the bottom end of the bottom side of the slide. It looks at alternative supply saying it will fill up its refineries up to its maximum capacity. And therefore, as you can see in the middle of the bottom of the slide, there is then no longer surplus refining capacity because it is allocating the gas up to the maximum capacity. In doing so, it will then create less gas into the sales channel to the external market. It will create more fuel and chemical products from consuming that gas up to maximum capacity. And therefore, if Sasol does that, it will create a higher weighted average margin than when it only supplies gas to the external market and then leaves surplus capacity in its refineries. The delta, or the difference between the higher average margin that it so creates when it consumes all gas up to the refining capacity and when it leaves surplus capacity, that delta in that component is then what is defined as the alternative value compensation, which then is designed to compensate Sasol for margin that it has foregone because it has decided to supply gas to the external market, as opposed to consuming all gas up to refining capacity and thereby creating higher margins. JP, if we can move to the next slide, please. The next slide is simply putting a couple of ideas on a slide to just enforce the messages that's been given already. So if we look at what alternative value dilution achieves and what it doesn't. So as I've said, it compensates Sasol for margin that's foregone by selling the commodity form to the external market. But we must also remember it is limited to Sasol's capacity. So it definitely does not apply this additional margin to the entire external gas market. If there is capacity if there is gas available that Sasol cannot consume or has the capacity to consume in its own refineries, that over and above gas that is available above the capacity is then still marked at the cost plus approach as regulated in the FY23 methodology. Also important on the left-hand side of the slide, just to look at what is being put forward as a maximum gas price application is a weighted average price. So it is weighted per the cost plus methodology for the gas that Sasol can't consume with its capacity today, and then the profit component of this alternative value dilution only comes into effect for the capacity that Sasol had to consume in its own refineries and thereby creating a higher margin. So it's a weighted average blended price. On the right-hand side, it definitely does not achieve a maximum gas price as per any of the previous methodologies. And the last methodology, obviously, using a price formulation. Can I continue?
Apologies, there's some background noise, Madam Chair.
It's actually from your colleague. It is Fatima Ibrahim there.
Okay, I'll continue. As I said, it doesn't achieve a maximum gas price that is akin to gas-on-gas competition, which was a previous price formulation methodology. And it also does not, as I stated before, add a profit component to the NERSA regulated profit margin that is allowed under the FY23 methodology. It replaces that profit component with the alternative value price margin. If we can move on, please, JP. In terms of how Sasol calculates alternative value dilution, so it calculates a gross margin by looking at actual sales prices achieved for FY23 on its refinery production slate, being chemicals and fuels. It then also takes or it reduces that margin or the sales price. So it takes the sales price less the variable production cost. The variable production cost, as can be seen on the slide, consists out of feedstock, process materials, utilities, all of the variable costs that Sasol will need to incur to produce this additional product. It therefore treats the fixed cost as being sunk cost, as you don't have to incur those costs again. They're already sunk into the refinery cost. The alternative value dilution per gigajoule of gas is then determined by taking the gross margin divided by the volume of natural gas used to create that gross margin. So it calculates a gross margin per gigajoule of gas. Okay, next slide, JP. Then lastly, I thought it would be helpful just to indicate how this works in terms of the physical price application. So as JP has mentioned before, and I think Rudy has re-emphasized that we're not, or Sasol is not touching the cost of gas or the trading cost. It's also not adding a profit component to the NERSA, which is indicated here as C. As you can see on the right-hand side, on that profit component, it adds 0 to that. So it doesn't add any profit to that. It replaces that profit with what is indicated here as D, and that D is what I've been discussing in terms of the calculation of the alternative value dilution. Then in terms of the weighting of the maximum gas price, it looks at total gas being supplied to the external market, and it deems that as being 100%. It then looks at the actual refining capacity that was available for FY23, which was not used because of external market being prioritized. And it then weights this price per the FY23 methodology, which is cost plus, versus the 30% indicated on the slide, which is all hypothetical numbers. But it then weights this price of 30%, which is then the Sasol diversion, which includes this alternative value compensation component, and it then gets to a weighted average price, which is then the price that JP has indicated before. We can move on to the next slide. JP, I'll cover the EBITDA component as well. So remember, we are now moving back into the regulated FY23 methodology, which allows an EBITDA component. Inside of the methodology, it defines 5 proxy companies, of which one can then get a weighted average of their profit component to indicate what the application needs to include in terms of an EBITDA margin. The regulations also indicate the right to the applicant to then go and review whether there are other more suitable companies as proxy companies. So we've applied the methodology as stated, and the criteria that was defined by NERSA in looking at the proxy companies, and we found that one proxy company, which is UGI Corporation, doesn't actually meet the NERSA selection criteria at the group level, which is at least 70% of the benchmark firm's revenue should be earned from gas trading activities, as well as companies must operate in the relevant product market for trading pipe gas and supplied gas on a comparable basis to trading companies in South Africa. We've therefore looked at that particular group, and inside of that group, there is a subsidiary, which is the utility company. And we are then saying, if you look at the utility subsidiary, that subsidiary does actually meet the criteria set by NERSA. So in the application, we therefore replaced the UGI Corporation, the mother company, with UGI Utilities, which is the subsidiary company. That's one change. And then secondly, when one also looks at the calculation of EBITDA, which we've recalculated from the actual annual financial statements available on Capital IQ, and per the regulations as we interpret them, we have then also backed out all once-off impairment charges that was included in the EBITDA put forward by NERSA previously, and that gives rise to some small differences based on the calculation of EBITDA for those particular companies. JP, that I think concludes my presentation.
Right, thank you, Chris. Madam Chair, I think the last element that we are going to deal with, and it will take me another 7 or 8 minutes to deal with that particular issue, is with regards to the 2 price applications that we've been discussing, is just to put forward the Sasol position and our submissions about the authority that NERSA has to indeed make the decisions that is the basis for the applications that Sasol has put before the regulator. Now, as far as the FY24 maximum gas price application is concerned, as we've indicated in the presentation, we've brought that application based on the 2023 maximum gas price methodology, the cost plus approach that NERSA adopted earlier in this year. The purpose for which Sasol brought this application on that basis, even though Sasol is fundamentally opposed to the regulation of the maximum gas price on a cost plus basis, is in order to move forward and to basically get out of the quagmire of the situation that arose in FY23, where we were basically caught in a situation where the previous year maximum price of 68 Rand 39 was imposed over the period, even though it was a different period. diversions from the methodology as been explained by Rudy and Christo in the presentation, and is in line with the principles contained in the methodology for those slight deviations and changes to the calculation of the profit element based on the average EBITDA calculation provided for in the methodology. And accordingly, our conclusion is that there is nothing that prevents NERSA from approving the FY24 maximum gas price as we applied for it. When we come to the FY23 maximum gas price application, the first question that arises is, well, why is this application required? Now, in terms of the 2021 maximum price decision by NERSA, there is an adjustment method that was included in paragraph 2D2 of that decision. And that was based on the international benchmark methodology. And as a result of the extraordinary movements in international gas prices, which formed the basis for those benchmarking, the maximum price yielded by that adjustment mechanism amounted to 273 rands and 42 cents per gigajoule. Now, both Sasol and NERSA concluded that that maximum price is not appropriate and could not be implemented in FY23. Hence, the fact that the charging of the maximum price from the previous financial year continued, notwithstanding the fact that in the financial year, Sasol was exposed to approximately 52% in increase only in the average acquisition cost. Notwithstanding the fact that NERSA, as set out in paragraph 7.13 of the consultation document on the FY23 application, concludes that this increase of the prices based on the 2020 methodology could not be allowed to proceed, NERSA has not taken any decision to establish a reasonable maximum gas price that should be and can be implemented over that period. Now, coming to then redressing the consequences of that, the fact that the maximum price that was yielded by the NERSA decision was found to be inappropriate and couldn't be applied, exposed Sasol then to the situation where it had to continue to charge the FY22 price, notwithstanding the cost increase that I've referred to. In the consultation document, NERSA indicates that the FY23 maximum price is inappropriate, and then as far as the recovery of the foregone value is concerned, NERSA acknowledges the need for such a recovery if one looks at the portion of the consultation document in paragraph 7.30 to 7.34 of the consultation document. And it's therefore clear that on these fundamental bases for the Sasol Gas application, it would seem that Sasol Gas and NERSA are aligned. In the conclusion contained in the consultation document, however, NERSA concludes that notwithstanding this, that the conclusion by NERSA is that the application submitted by Sasol Gas would not be approved. And in the consultation document, NERSA basically puts forward 3 reasons why the application should not or cannot be approved by NERSA. The first reason put forward by NERSA is that there is inadequate information for NERSA to evaluate the application. Now, Sasol Gas has provided all the required information, as we heard from Christo earlier in the presentation. The whole issue about the the basis on which the alternate value dilution element of the price is concerned. That additional information listed in paragraph 7.60 of the consultation document was provided to NERSA. The cost changes and the adjustments in the acquisition cost during FY23 was also submitted to NERSA, and therefore NERSA is in a position to have due regard to the cost of Sasol Gas as is required in terms of the decision by the Constitutional Court directing that NERSA takes due regard or have due regard to Sasol Gas's cost in determining a maximum gas price. And then, as we've just heard with regards to the calculation of the EBITDA profit element in the cost plus part of the price, the explanation for the data sources and the basis on which that calculation was made by Sasol was explained, and the underlying information in that regard has been submitted to NERSA, and therefore all the information required by NERSA to take an appropriate decision is before it. The second reason that NERSA put forward with regards to not being able to approve the application as presented is that the price level is inappropriate. And as we've just heard from the explanation from Christo in support of the alternative value dilution compensation, the basis for that element contained in the calculation of the maximum price is clearly explained, and it would be unreasonable to end up in a situation where the licensee is obliged to charge a price that does not take into account the alternative value that the commodity has in the hands of the supplier. And then lastly, Madam Chair, the third argument that NERSA proposes as to why it may not be possible to approve the application as presented by the applicant is a conclusion on NERSA's part that it might not have the necessary authority to make a decision approving an appropriate FY23 maximum gas price. Now, Sasol submits that there are at least 3 avenues within NERSA's statutory powers in terms of the Gas Act as well as the NERSA Act that allows NERSA to make an appropriate decision for the FY23 period. The first avenue is the rationality test that is contained both in the 2020 methodology, particularly paragraph 4 and 8 of that methodology, but in the 2023 methodology, the rationality test and the need for NERSA to conduct a rationality test in order to ensure that the maximum gas price applied for adheres to the Gas Act and the regulations is once again included in the methodology. And it is also very telling that in paragraph 7.21 of the consultation document published by NERSA relating to the FY24 application, NERSA confirms that a rationality test of this nature can be initiated by a licensee. A second avenue that is at the disposal of NERSA in order to approve a maximum gas price that is appropriate for the FY23 period is to revise the adjustment that was provided for in paragraph 2D2 of the 2021 decision. At the time when that decision was taken, the necessary information that was available or required in order to do the rationality test was not available. But to the extent that that change in the adjustment as provided for in the decision is deemed by NERSA to be a change to the existing existing decision, it is submitted that it is possible for NERSA to take such a decision because at the basis of Sasol Gas's application lies the fact that that Sasol Gas, as the beneficiary of the maximum price decision in 2021, has relinquished the decision insofar as it applies to FY23. In essence, relinquishing the 273 maximum price that part of the decision yields and requesting NERSA then to approve a replacement price in the amount of the 107 rands that we've put before the regulator. And then the last avenue that we want to submit that NERSA has at its disposal in order to approve the application that Sasol has made is the fact that in the description that NERSA puts forward for the determination of maximum gas prices in response to an application by a licensee, NERSA indicates, and I refer there to paragraph 4.3 of the consultation document on the FY23 maximum price application, NERSA indicates that to the extent that it is not possible or the applicant is not willing to reconfigure the application that it has presented to NERSA in order to enable the approval of that application, it is within the power of NERSA to then determine the appropriate maximum price that should apply during the period in question. We further submit that in circumstances where up to now no such formal decision to make an appropriate maximum price for FY23 has been made by the regulator, and the regulator has concluded and has repeatedly indicated that the prevailing maximum price is unacceptable and can't be allowed to be implemented. It is the obligation of the regulator to address the situation and to indicate what an appropriate maximum gas price is then for the period in question. On that basis, it's our conclusion that the price that Sasol is applying for FY23 should be approved by the regulator, together with an appropriate recovery mechanism over a fixed period of time in order to allow Sasol to recover the foregone value that it suffered as a result of the consequences set out regarding the increase in the underlying cost and the fact that Sasol was forced to retain the FY22 maximum price up to now. In the alternative, if NERSA at the end of the process relating to this application comes to the conclusion that it does not agree with the price level or the recovery mechanism that is proposed by the applicant, then in keeping with the authority that NERSA has indicated in its description of the process for dealing with maximum prices of this nature, NERSA is in a position then to determine what the appropriate price level would be, and Sasol is simply requesting that in the circumstances, NERSA does actually take the decision to indicate what the appropriate maximum gas price for that period would be.
Mr. Mendes, may you please wrap up? We have given Sasol more than enough time. If you can kindly wrap up the presentation.
Madam Chair, that brings us to the last slide in the presentation, and that is just to confirm that in respect of the three applications that are before the regulator today, in respect of the FY24 period commencing on 1 July 2023 up to 30 June 2022, the request is for the approval of a maximum gas price of 78.23 Rand as at 1 July. and for the regulator to also approve a quarterly adjustment of that maximum price in line with the underlying changes on a quarterly basis in the average acquisition cost, and that be monitored and confirmed by NERSA on a quarterly basis. With regards to FY23, Sasol submits and requests that NERSA approves a revised maximum gas price of R107.43 for that period, together with a recovery over a fixed period in order to allow Sasol to recover the foregone value. And then in respect of both of the maximum price applications, Sasol confirms that it will accept the 5% discount relating to the maximum gas price to apply to traders and resellers. And then insofar as the transmission tariff application is concerned, we confirm that Sasol is requesting the approval for the 24 and 25 period of the tariffs as applied for in the application by Sasol Gas. Madam Chair, that concludes the presentation on behalf of Sasol Gas.
Right, thank you very much, Sasol Gas, for the presentation. I would like to invite members to engage with the presentations, and when they ask questions, if you can kindly indicate whether the question relates to a maximum price application for 2022-23, or it relates to 2023-24, or it relates to the transmission tariff. If you could kindly just indicate that, so that it is very clear. But the time that they have taken, at least it covered all of the three applications. That also saved time for us. Shall we then ask questions, members, by show of hands, if you have any questions to ask from the Sasol team? By show of hands, members, if you have any questions. Let me start off with Mr. Mkize. Mr. Mkize, any questions from your side? Followed by Mr. Gumede.
Thank you very much, Chairperson, and thanks to all the presenters. I'd just like to get clarity when Brenda presented right at the beginning regarding, I would say, drilling the dry wells. I would just like to know, is the expectation that ultimately customers must then bear that cost of dry wells, in the sense that there is an inherent risk in the upstream side of the business? So just like to get that clarification. And the issue also of insufficient gas, and I'm not understanding how then it gels with the alternative value that was raised, the alternative value dilution, because you might end up with the gas not being there in any event. Just want to get the clarity. And also when it comes to alternative value dilution, doesn't Sasol already have contracts with its customers requiring them to sell gas instead of processing it in secunda anyway? That would be my question. And then on the application for 1st July 2022 to 30 June 2023, why not follow the clawback route? Just want to understand why not follow the clawback route. And then with regard to the unhappiness regarding cost plus methodology, are you unhappy with the cost plus methodology, or you are actually arguing that as is the cost plus methodology does not incorporate certain costs, that you are of the view that they should be incorporated? And lastly, from my side, you spoke of the quarterly adjustment. Have you satisfied yourself that such adjustment will be fair and just to both yourselves as a supplier and your customers, considering the environment they operate in? That would be all. Thank you.
Thank you, Mr. Mkhize. Mr. Kumet.
Thank you, Chairperson. Good morning again to you and as to Sasol, to all the presenters and everybody on the platform. I've just got 3 questions of clarity, Chairperson. 2 are related. The first one, I think for me, is just, as I indicated, it's just a question of clarity. Is it the Sasol's view that NESA's methodology, maximum price methodology, is in fact regulating upstream gas? Does NESA have a mandate to regulate the wellhead price of gas? That is the cost of gas. I'm just trying to understand the link between upstream activities and what I thought that NESA's mandate was regulating the downstream business. Maybe if I can be clarified there, what the issue is. That this relates to slide 3, I guess, and the basic construct, I think, of all of the argument put across by the CFO. I think for me, just the clarity that is in Eskom, in Sasol Gas's view, does NESA regulate upstream? So that is the first question. I guess just to clarify that says, because for me the question then is, all of the costs, generally upstream has got its own ways of how costs are actually recognized and capitalized over a period and then written off if you find something. I mean, there are lots of things that are governing the upstream price, gas price system. Is the view that our pricing as NESA, that it actually seeks to regulate that upstream price as well? The second question, it relates, I guess, in the main, it's also part of the introductory slides, but around the cost plus methodology. The argument is that gas is a commodity, but so are petroleum products. And Sasol as a business is big on petroleum products, and the petroleum products are also regulated on a cost plus basis. Whatever that the import parity system that is used, but it's still a cost plus basis. Why is it? Okay, maybe the question, let me understand this. Is therefore the question I'm asking is that why does Sasol see gas to be different as a commodity from the petroleum products? And if so, why? I mean, both are basically, if you like, the internationally traded commodities, dollar-denominated commodities, and so forth. And so forth.
You got it, Lisa?
Yeah. May you please assist Gerald to mute those that are speaking? We requested that everyone keep, if you can kindly keep your mic off, please, so that you don't interrupt the proceedings. You may proceed, Mr. Kumet.
Thanks, Chairperson. So I guess what I'm saying for me is that is it the view of Sasol Gas that the gas itself is a different commodity or rather, it should be treated differently from the other commodity, which basically is crude-based commodities. And for me, it would be nice to understand why. So that is the second question. And then lastly, based on slide 14, I think just for me, this one is more, again, as I said, it's a clarity-seeking question. The Sasol Gas business is an asset-based business, unless if maybe again, pardon my limited understanding of your business, but from what I understand is that it's an asset-based business. That your trading is in fact asset-based. If it is indeed an asset base, why then add this component of EBITDA? Because you would already have a risk commensurate return that is calculated in the trading cost. Does this, in the case of Sasol, not amount to actually accounting for profit twice? Thanks, Chair.
Thank you, Mr. Kumete. Just checking who the other hand. Ms. Mpungose.
Thank you very much, Chairperson. Thank you to the Sasol team for the presentation. I just have one question for the team. It relates to the alternative value dilution. What I wanted to find out is that principle, a global principle, a standard principle that applies globally, in the regulation of gas markets, and also in instances taking into account that Sasol is what is considered to be a natural monopoly. Would that still be relevant? Because I would assume that I take it that Sasol knows that they have certain obligations, to make gas available to their primary market and customers. They have that obligation because they are the natural monopoly. So how do they then come up with this particular principle to say they should be compensated or reimbursed for the less they are making in case where they cannot consume the natural gas internally within their business because they have to make it available to external customers? How do they then justify that thinking, taking into account the obligations they have by virtue of them being a natural monopoly? Thank you.
Thank you, Ms. Mpungose. I do have questions that are asked through Mr. Elias Dlamini. The first question, it comes from some of the traders. The question from the traders is why Sasol is compromising on the reseller discount only to state it as 5% when the methodology says a minimum of 5%. So that is the first question. What is their opinion on differentiated prices between resellers and end consumers? That is the second question coming from the audience. The third question is, why didn't Sasol propose the value dilution and any other variations during the public consultation process for the approval of the methodology? Why do you bring it up at this point when the methodology is implemented, when you could have suggested some of these principles at the time when NERSA was consulting on the methodology? So that is the third question coming from the floor. I do have some questions as well, just for clarity, starting off with the FY 2023. As you pointed out, Mr. Menkes, the decision of the energy regulator that was made in April 2021 for a period of 2 years still stands, and the maximum price there was 68 rands for that period. 68 rands. And then there's a component of the decision. That component of the decision allowed that there be an adjustment of that 68 rands. So that the part that Sasol could not give effect to is just the adjustment. But the 68 rands as a decision of the energy regulator stands. It is only the adjustment of that 68 rands that could not take place because it could have been irrational and excessive. Now, all that is needed for fairness, because you are given the right through the decision to adjust the price. Now you are asking that price be adjusted. But the way in which you are asking, you are applying for a new price. And the question is, where would NERSA then get the legal mandate to process a new price? Because the maximum price decision still stands and is still valid. And the law stipulates that the decision of the regulator must be reviewed by the High Court. And you will know that at the end of May this year, there was a review of that decision. and the judgment is still pending on that decision. So as we speak here today, we still do not know what the High Court is going to say about that very decision of 68 rands, as well as the adjustment aspect of it. As of now, it is still valid. So that is the first thing. How do we deal with that? That first, the fact that there's a valid decision of the energy regulator and the law stipulates how that valid decision can then be set aside. And that process has already been undertaken. We're just waiting for the judgment. That's number one. The second thing is that the other complication with the FY23 price is the fact that it has been applied for in April or March of this year, when it was supposed to have expired in June 2023. Now, what do you say about the principle of retrospective application? How would NERSA deal with the issue of retrospective application? That is the second thing about it. The third thing about it is that why, if then you had the right to adjust the price and it could not have, it was not adjusted at that time, why is it not appropriate for Sasol to claim a clawback, or NERSA then look into the clawback and look at the amount and the level of that clawback that can be applied in the case of Sasol, if you can clarify that issue of the clawback. The other challenge again with this application for 2023 is that you are applying for. You applied using a methodology that never existed in 2022. This methodology was only approved by the energy regulator on 26 January 2023. Now, you can't then say you can't use the new methodology, even if there's going to be a clawback. The clawback must use the methodology that was used to determine that price. Now you're using a different regulatory framework for a price that ought to have been implemented in July 2022 until June 2023. And for 2022, this methodology never existed. It only existed on 26 January 2023. So how does the energy regulator deal with that aspect? That is another issue that you should at least clarify in this case. And the other question is, we want to understand: does the gas price that Sasol pays its upstream supplier not reflect the new exploration cost? Exploration cost, as well as the risk from the upstream business, not already taken into account in the acquisition cost, which are then the cost of gas for Sasol. Yes, we understand the upstream business. Nobody will make money there, because in the upstream, all that you do, you extract the gas, you clean it, the gas, you do all of the separations, water, whatever, the things that you do. Then the business kicks in at midstream as well as downstream, which is NERSA's role, which will then, the price for the molecule will then be recovered. But what we are asking is whether the price, the acquisition cost, does not cover all of these investments that you indicated, number one, and all of the other risk and all of the exploration cost and sunk cost that are encountered by Sasol Gas at the cost of acquisition that you apply for, if that can be clarified. And that is all that we have for now. Thank you.
Madam Chair, that's quite a challenging set of questions. So let's see how we can deal with that. I'll also call on my colleagues to assist. I think the first question, just the ones that one can deal with quite straightforward and simply. I think the the clarification question that was asked about the regulation of the upstream price, I think we have to clarify that the price that we are talking about and the authority that NERSA has to regulate prices relate to the price in the market, in the downstream market. NERSA does not regulate and does not have authority to regulate upstream prices. With regards to the other questions regarding to the upstream risk and the inclusion of cost there, I'll defer to one of my colleagues in a moment. With regards to the question about whether there isn't already contracts with customers to supply gas and not being able to supply the gas to our own facilities, I think it's important to take into account that the point that we are discussing is the price and the value at which this gas is supplied and delivered to the customer. Mr. Mkhize is quite right. I mean, we've got contractual obligations to supply gas to our customers. All that we are arguing is that to the extent that there is a alternative value that could have been derived from the gas if we did not supply it in terms of the contracts. In that case, that alternative value in the hands of the supplier has to be taken into account in determining the maximum price. And obviously that supply did continue, and that supply to the customers did in fact take place. I think, Brenda, with regards to the question about the risk on the upstream business of drilling dry wells, as well as the question about that Ms. Masetti raised about whether the upstream risk is dealt with elsewhere in the value chain. Can I ask you to maybe just deal with that?
Yes, thank you so much. So, Mr. Mkhize, Mr. Gumede, those were really good questions. So let me try to clarify. So I think it really touches on the point that the question that the chair was asking is that currently the pricing of Sasol Gas, the acquisition cost, does not include exploration. It does not include depreciation. So that's why I say it's a development cost, right? So the capital that we are incurring in the upstream, that when that comes through as depreciation, it's not included. And it does not include depreciation as well as any rehabilitation costs. So as you can imagine, is as these fields are starting to get older, there is a significant cost that's incurred to actually rehabilitate these wells as well. So hence, when you reflect and just stand back and you say, does the current price that we're achieving, which is 68 Rand, does it compensate us adequately for the risk that we are taking in order to secure gas supply to South Africa? And that's where we are putting it forward to NERSA to say, in the future periods, into FY25 and beyond, can we look at the methodology to rather reflect a cost price that would actually support then future investment into South Africa? The second component is around the dry wells. And again, it comes back to saying the price that we are putting forward in terms of what is that maximum gas price, does it adequately compensate for the risk that we are taking? It is not our expectation that customers will actually pay for the dry well costs, but that the price that we are actually charging to customers should reflect the risk that we are taking. The numbers that I shared with you, the 5.4 billion to extend the plateau to 2026, the 900 million of the dry well cost just is an example of what we have spent and taken upon ourselves to ensure gas supply to the market. In effect, you'll see on our slides, we also reflect that that creates a perception that we're almost subsidizing the market in terms of ensuring that gas supply. Perhaps, Mr. Gumede, you also asked the question in terms of, does NERSA have a mandate to regulate the upstream? And I think JP has answered that very, very eloquently. But again, what the point that we were trying to make is you do not regulate the upstream, but how do we ensure a fair and equitable price that allows for the sharing of risk and rewards? JP, if it's okay, perhaps we refer the question on the alternative value to Mr. Roux at this point.
Yeah, Christy, if you can maybe deal with the question about the cost plus and whether cost plus actually applies in the fuel market as well. And if you can also deal with the question about whether the alternative value approach that we are proposing, to what extent is that supported from an international basis?
Thank you, JP. So I think the first question around alternative value was why does Sasol then go for alternative value dilution if there's limited gas resources into the future? So I think it is important that the alternative value dilution concept is limited to FY23, and it has actually been actualized in terms of Sasol's financial year end for 2023 only. So it doesn't really make a difference there to argue limited gas resources into the future, as that is limited to FY 2023. I think on the cost basis, if we draw a comparison between international fuel pricing and the regulations around fuel pricing in South Africa and how that works versus gas pricing, I do think there is a difference when one looks at the VFP price setup and how that is calculated from an import parity pricing or a principle that tries to achieve import parity pricing, as it is based on an oil indexation versus a cost plus approach, because obviously you will then link it into international crude pricing. And whoever can then supply fuel into South Africa, whether you refine it here from coal gas or whether it is an imported product or imported crude refined in South Africa, you achieve a price that is not linked to you as the refiner or the supplier, whereas this methodology here on a gas principle looks at cost plus and cost being defined as per the supplier specifically. So the supplier's cost then specifically, which I do think there's a difference. And if we look at cost plus principles, I think there was also a question in terms of international benchmarks. When one looks at international benchmarks and the pricing, and that's also obviously included in the FY23 and 24 application, cost plus principles for regulating pipe gas is very infrequent that we see that use in global indexation. And obviously the most used methodologies would be linking it either to a global gas basket, as was previously done, or international oil price, so oil price linked gas pricing. Those are the two most frequently used gas pricing approaches globally.
May I just get clarification here in terms of the markets that were used for the value in trying to find the value for gas here, the value that you rely on here? What markets were used? And we also do know that oil indexation is not the only way or mechanism for pricing of gas. That much is well known, and so it would not be oil indexation alone. There's also gas on gas competition, particularly with two markets around the world, which is your NBP in the UK as well as the Henry Hub in the US, and then you will have also the main one being the TTF. Although the TTF prices are always very volatile and very high. So that much we know, and in some you also get the oil derivatives, especially with some of the import markets such as your Japan and South Korea and other markets. But then in markets that produce gas, they're the ones that usually will charge the cost plus mechanism. So it's various ways. So they won't only be indexed to oil. So I just wanted to bring that aspect up to yourselves. Can we understand what markets are you using here so that we can understand, because NERSA has a role to play here. NERSA's role is to regulate the prices, price regulation, and there's a purpose for doing that. It is because the supplier currently is a monopoly. So NERSA's role is very clear. It is one that must make sure that we curtail market power that can be manifested through a level of the price. That is our role. And therefore, because we want to curtail any possible market power, we therefore need to come to some sort of a competitive price. That much is very clear in terms of Section 21(1)(p), and also it was articulated by the senior courts, including the SCA, the Supreme Court of Appeal, that we need to determine a competitive price. Now, if you are taking us to the alternative value, can you tell us what markets did you look at which you believe, therefore, that this price that you are requesting the regulator to consider is a competitive price?
Okay, I understand, Madam Chair. So let me just clarify. I was merely responding to the question that Mr. Gumede asked around why would we want to argue that there is fuel price can't be regulated on cost plus when, or gas prices can't be regulated on cost plus principles when in South Africa the BFP pricing does actually regulate on cost plus, where as I said before, the alternative value dilution compensation that Sasol is including in the FY23 application is only limited to the profit component where Sasol had surplus capacity in their refineries. It does not at all relate to the cost component or the trading cost component that is used in the price build-up. So I was merely responding to that question. It's not that it is linked in any way to a different principle. In fact, the alternative value dilution component of the application relies exactly, and you will see that in the application, the cost and the trading cost is exactly the same as per the cost plus principle, the FY23 NERSA methodology. The only difference in the alternative value dilution comes into the profit component of the application. I hope that clarifies my statements.
I think, Madam Chair, there's two questions that I can deal with. The one is the question about the quarterly adjustment and whether that is fair and reasonable. The quarterly adjustment is proposed as part of the application for the FY24 maximum gas price application. And in terms of the methodology adopted by NERSA and on which this application is based, the underlying basis of the maximum price is anchored in the weighted average acquisition cost. Now that weighted average acquisition cost adjusts on a quarterly basis with the indexing and the reference items that Rudy explained earlier in the presentation, and therefore on a quarterly basis that acquisition cost may move up or down as the case may be. Where the fairness and reasonability around the quarterly adjustment comes in is when you find yourself in this cost plus approach that this price is based on, then this quarterly adjustment of the underlying acquisition cost ensures that the market stays abreast to the movement in the price as it occurs on a quarterly basis, rather than exposing either the supplier or the customer, for that matter, to inappropriate price changes over a longer period if the adjustment is not kept in line with the adjustments as they occur in terms of the acquisition agreements. And on that basis, the quarterly adjustment as we propose it is fair and just both to the supplier and the customers. I think, Rudy, if I can ask you to respond to the question relating to the asset based nature of the business, as well as the two questions relating to the differentiation between end user maximum gas prices and trader maximum gas prices. Please, Rudy.
Thank you, JP. I think just in terms of the question about the asset-heavy nature of Sasol Gas, what we must do is we must separate Sasol Gas into its regulated components, and those are, there's a trading business, which is the subject of the application for the maximum prices, and then there is the transport business, which comprises transmission and distribution not being regulated. But in the infrastructure business, which is the pipeline portion of the business, that's a very much an asset-heavy business. The trading business is not an asset-heavy business. And I just want to maybe, when we say that, just go back to the cost-plus portion. So what we've always argued is that we don't like cost-plus, and that we are prepared to live with the consequences of what benchmarks give us. And just to add to what Krista has said, I think it's got to be very clear that the basic fuel price is a benchmark price. It looks at the value of fuel in major refining centers around the world. Those price assessments are then used as a basis, and a refinery in South Africa has to compete with these international refineries, pretty similarly to what a trader in South Africa would have to, compete to prices that are achieved in international markets, as per the previous methodology. So I think, from a fuel point of view, the portion that's cost plus are the elements that are added to the basic fuel price. And in gas, it's probably quite similar. We argue that we should determine, the gas price with reference to international prices, and then there are the transmission and trading activities that are added to that, which are on a cost basis, but the molecule should be determined with reference to competitive markets. From the application or the differentiation between resellers and end users, what we are suggesting is that we'll follow the methodology as NERSA has determined it, to make a final decision on what the differentiation between those is once we have a decision. Thanks, JP. I hope that answers those questions.
Yeah, I think sorry, let me just put my screen on again. I think, Madam Chair, the last set of questions to deal with then relates to the question that you posed relating to the adjustment as contemplated in paragraph 2D2 of the 2021 maximum gas price decision. Now, the price of 68.39 Rand is also the result of an adjustment that was applied on a similar basis, because paragraph 2D1 of the 2021 maximum gas price decision contains the same adjustment mechanism. Obviously, the basis for that adjustment is the price in the previous year, which was in the order of 44 Rand, which was approved by NERSA for FY21, and then based on the adjustment mechanism which relates to those three international gas markets, the adjustment for FY22 then resulted in the 68.39 Rand. That now becomes the base, and in terms of paragraph 2D2 of the 2021 decision, there should be an adjustment, and the adjustment method prescribed in the decision by NERSA is then similarly an adjustment based on those international benchmarks. But as we've indicated, those international benchmarks for that period the adjustment then led to a price that is inappropriate and which NERSA concluded could not be implemented as a maximum gas price in the market and in the period in question. However, it still leaves us in a situation where there is not a decision on the part of NERSA or an adjustment that has taken place in terms of the existing decision that that NERSA made in 2021, and as you rightly point out, which is subject to the review application that you referred to. In essence, what Sasol is applying for then is the approval of a different adjustment than the adjustment that gave rise to the 273 price, and to approve an adjustment that gives that yields 107 rands 42 price on the basis that we have put before you in the application and in the presentation today. The legal basis for that application, or for NERSA to approve that application, is the avenues that I've explained earlier, is that it is either an application by NERSA of a different adjustment in order to approve an appropriate maximum gas price in a circumstance where NERSA already concluded that the adjusted price that was yielded by the existing decision is inappropriate. However, the other basis on which that can be done is, as we've indicated, is to the extent that NERSA, after conclusion of this process, comes to the conclusion that it doesn't agree with the price proposed, or the adjusted price applied for by Sasol Gas, it still finds itself in the situation where it's obliged to then indicate what indeed is an appropriate price, and not to simply not approve the price that the applicant approved or applied for. When it comes to the retrospective nature as a result of the fact that the FY23 period has now passed, in the application that Sasol has made, it has asked for NERSA to approve that Sasol recovers the difference between the price that was actually charged and the price then approved by NERSA. To the extent that ultimately NERSA comes to the conclusion that in its approval of such a recovery, it wants to couch that decision and that approval in the form of a clawback, that mechanism is available through the content of the methodology and the reference to the tariff methodology that is contained in the methodology. Where Sasol, however, differs from the proposal that NERSA is making, is that to the extent that the clawback only allows the increase in the underlying acquisition cost, Sasol does not agree that that's the appropriate way to approve and to implement a recovery of the nature that we are requesting, and that clawback should include the move in the prices in order to cater for the profit component which is provided for in Regulation 4.3. Because if it's only the cost change that is allowed, then obviously the profit element on that increased cost that Sasol faced during FY23 will be lost and will also be forgone. Insofar, and this is the last question to respond to, Madam Chair, insofar as your question about the utilization of the hybrid methodology, the situation that the regulator and the applicant finds itself in is that in terms of the period prior to the adoption of the 2023 methodology, the 2020 methodology is the benchmark methodology which created the inappropriate maximum price level in the first place. and therefore to revert to that 2020 methodology in proposing the competitive price to be approved for the market seemed to be impossible, because that methodology itself was the origin of the problem that we are trying to redress. What Sasol has opted to do is to put forward, in combination between the cost-plus approach adopted in 2023, as well as the compensation for the alternative value dilution, a price which is reasonable and is a price that mimics a competitive price in a market, because, as you've indicated, the role that NERSA plays is in a market where there's inadequate competition to establish and approve a maximum price that simulates what that price would have been if there was competition in the market. I think the term that NERSA is utilizing is a workable competitive market. That is the criterion or the benchmark that NERSA is striving for. And we are submitting that the 107 Rand, based on this hybrid approach, is a price that mimics such a price in the market. However, we fully understand that in NERSA's evaluation of the application, the methodology that NERSA has adopted for the period in question will also be utilized as a yardstick by NERSA to ultimately come to a final decision in regards to this application. So I think that that concludes the answers on this set of questions that the panel has posed, Madam Chair.
Thank you. Thank you very much, Mr. Minkis. I think there was another question from the members of the public here, and the question relates to the issue of costs that are not included in the acquisition costs that will incentivize investments so that Sasol can ensure that there is sustainable supply of gas to the South African market. So that's just the background. So what the stakeholders would like to understand is they are saying that Sasol says they need to cover the cost of exploration, depreciation, development, and all that. And this needs to be taken into account for purposes of securing future gas supply for the South African market. So they want this cost to be included in the maximum price. However, we have no firm undertaking or agreement that once the gas is found, it will be used for the benefit of the South African consumer. And Sasol will not just turn its back on South Africa and use the gas for themselves, even through South African, even when South African consumers have funded it. So I think is the issue of not being aware if the market, if you are of the view that yes, we are facing a depleting resource, that is for sure, and therefore for South Africa to secure the security of gas supply, then it means that the market must also be able to compensate the efforts for investments. However, the market is also concerned that because you're also utilizing gas for yourselves, then what will the market have if they have contributed to this investment and the market does not know what Sasol might do in the future? That is the essence of the question. If you can respond to that question, please.
I think, Brenda, can I ask you to maybe take a stab at that question, please?
Thank you. Thanks, JP. Thanks, Chair. I think one is just demonstrated performance. Although we were not compensated by the market, given our commitment to South Africa, as a proudly South African company, right, our commitment remains firm, is without being compensated, we actually invested on our own and we've increased the plateau from 2024 to 2026. So our Form 20F, which is our US filing, will be released early next week. And that is, will be evidence to our different stakeholders to show what we are putting on the table. All that we are saying now is that 68 Rand is not going to allow us to continue to do that. We need to work as a community. We need to work as aggregators to say, how do we solve this challenge now for the country as a whole? And hence we are engaging with our current gas customers to look at how we can aggregate demand, how can we work together to secure this future gas supply. And that's all that we're asking for, Chair. And I think given that we have this demonstrated performance, we know that it is a significant challenge ahead of us, but no doubt we believe we have what it takes collectively to solve for this.
Yeah, but Sasol has changed the way that it contracts, and this is not to get into the contracts issue. I know that in terms of the regulations, NERSA, in terms of our regulations, NERSA can ask for the contracts, the gas supply contracts between Sasol and its customers to look into the terms, the pricing terms and all of that. So I'm just giving the context in terms of the regulatory framework. But the question that I would like to pose is the duration of contract, because Sasol, it appears that it contracts for a short period of time. So in terms of certainty to the market, and also for the customers who are also industrial customers who might need to have certainty over the price path, and also for securing the supply of gas, the issue of the short duration of the contract is an issue. And also if one then says, we're looking at the long term as the supplier to be able to service the South African market, but the way that you contract with your customers, they don't get the benefit of that long-term perspective that you have in your contracting.
Brenda, maybe just before you respond, I think Nomfundo, the comments about that and the concerns around that is a point well made, and something that we have to take note of. I think we must just bear in mind, in the interest of time, that the applications that we are talking about today deals with the very particular period of FY23 and FY24. And to the extent that this issue that you are raising, Madam Chair, is something that have to be discussed further, it would be probably more appropriate to deal with that in a different forum. But at this point in time, obviously the applications that Sasol are making is for the approval of the maximum prices for these two periods on the grounds that these applications have been submitted. Brenda, I don't know if you want to add anything there.
No, I think that's a very good response, but it was just to reference the investment made to date to just extend the gas supply to 2026.
Okay, no, that is fine, but you must also bear in mind that to the extent that your submissions here are that the price level is not adequate to cover the investments, and you are saying that the acquisition cost, that is your submission, that the acquisition cost do not take into account certain cost. And then the industry's reaction to that is to say that, yes, but if you want the industry to understand this, that these costs are not covered, what does the industry have? How does the industry? So for me, it is very much linked to the submission that you are making. And therefore the industry say, you want this, then what do you give to us for us to be able to secure the very future that you are talking about? And that also talks to the duration of the contracts. And the duration of contracts in terms of Section 22 of the Gas Act, it is one of the objective reasons that the energy regulator can take into consideration. That is number one. Number two, then once you secure that gas, there's an issue of allocation of that gas to the market, which is the essence of the question that is being asked. Aren't you going to prioritize yourself, forgetting the fact that the industry contributes to not only get the gas molecule investments for the South African market, but also even to the infrastructure that must transport this gas to the South African market? And that is the fair question also from the side of the industry. And we must therefore balance the interest of the industry as well as the interest of Sasol, so that they can find each other and ensure stability in the supply of gas.
We hear.
Well, the point is well made, Madam Chair. We take note of that.
Okay. All right, thank you very much. We hope that you will be able to clarify these questions to the extent that you would like us to take into consideration some of these points that you have made regarding the inadequate recovery of some cost that will ensure sustainable supply of gas. I think it is within that context. So to the extent that that is your case that you're also making before the regulator, you must also take into account what is it that then you will make sure that you make a commitment and also ensure that obligation on your obligation to supply once then their cost that the industry must incur. All right. Thank you very much, Sasol, for your time and for clarification. And you have covered all the three applications. We now move on to the next presenter. And the next presenter is Mr. Yako Human, representing IGWASA. Yako. Okay. Thank you very much. Good morning. Good morning, Yako. Do you have any objections in taking the oath?
I don't.
All right. May you please raise your right hand and affirm the following. Do you solemnly declare that the evidence you're going to give to this panel is the truth and the whole truth?
I do.
Thank you very much. May you please state your full names and your designation at IGWASA.
My name is Yako Human, and I am the Executive Officer for the Industrial Gas User Association of South Africa.
All right. Thank you very much. You may start with your presentation.
Thank you, Madam Chair. The objective of today, while I'm bringing up the presentation, is to not deal with the substantive submissions we've made in our written responses. Instead, what we would like to do is just cover the heads of these points that we've raised, and at the same time, of course, deal perhaps with a level 1 or a high-level review of these particular substantive points. What we aim to do, Chair, is then to deal with the applications of FY23 and FY24 as Sasol has just now in one go. If that is acceptable, we will appreciate that. Of course, just by way of introduction, Madam Chair, IGWASA is a industry body, not for profit, that represents the interests of large industrial gas energy users. In this instance, we have various industries in KwaZulu-Natal, Mpumalanga, and of course Gauteng that are currently being supplied by Sasol. The basic mandate of IGWASA is around price, because it's a regulatory environment, policy positions in terms of the government policy positions on gas energy, and of course then the gas energy security. Chair, we would like to structure our conversation today in two chapters almost. We will firstly deal with the FY23 application by Sasol, and we will make some opening remarks. We will then refer to my colleague Lebogang, most likely on legal comments. We will then do economic commentary, and then do Q&A on the FY23 application. After that, of course, a repeat, and then some general remarks at the end. Chair, I think just by way of procedure, I would like to introduce our colleagues that will co-present with me today. It is Advocate Lebogang Motladi, and then Simon Lee on the economic side. If you wish to them to take the oath, Lebogang, Simon.
Okay, let me do that. I'll start off with Lebogang.
Madam Chair, as an advocate, I'm just here to make legal submissions, so I don't intend to traverse any factual findings. And so I've been made aware of the fact that there is no need for me to take an oath. But if it is pleasing to you, I'm happy to do that either way.
All right, so you are going to confine yourself to legal submissions only, and you would not touch on the evidence and the facts.
No.
Okay. All right. Okay, we can then go to Mr. Simon Lee.
Good morning, Madam Chair.
Good morning. Do you have any objections in taking the oath?
No, I don't.
All right. May you please raise your right hand? Do you solemnly declare that the evidence you are going to give to this panel is the truth and the whole truth?
I do.
Thank you very much. May you please state your name, your organization, as well as your designation?
My name is Simon Lee. I'm a senior associate at RBB Economics, instructed by Norton Rose Fulbright, the attorneys advising IGWASA in this matter.
All right. Thank you very much. All right. You may start with your presentation, Mr. Human.
Thank you, Chair. By way of some opening remarks, I would just like to address some of the comments that were made earlier by Sasol in terms of its FY23 application. It is our view that Sasol should be careful not to mislead the regulator in various statements that it's made. And for that, I would just like to provide some points of clarity on certain statements that were made earlier by our colleagues from Sasol. It is true that Sasol is spending capital in Mozambique in order to secure gas energy. That, of course, is a half-truth in that Sasol is only spending about 5% of that capital on its PPA, the gas that comes across to South Africa. The other, Madam Chair, is spent on PSA, which is an obligation, a license obligation under its PSA license that is designed for domestic consumption in Mozambique. So that is an important point to make, and just to provide some further clarity to the statements around the extensive capital that Sasol is indeed spending. If one then looks at Sasol's profit margins, Sasol continues to make significant profit margins, and that is borne out by their EBITDA margins that they earn year on year. Even over the last year, of course, where pricing remained flat, Sasol managed to improve their internal margins or their gas business margins at an EBITDA level. From a commitment perspective, Chair, Sasol, we find it strange that Sasol refers to its commitment to the South African economy for gas supply and gas energy security. It is just confirmed last week that there will be no gas supply from 26 onwards, and we find it difficult to listen to the application for FY23 in the context of these particular statements. Furthermore, on a contractual environment, Sasol is at the same time communicating to the market that it will not be renewing any contracts from 2024 onwards. Sasol, at the one hand, on the one hand, is pleading for a stable regulatory regime and the recovery of cost. Now, we certainly believe that those two go together, but we have not seen any evidence from a cost recovery perspective. Sasol has not submitted anything substantial to consider by the market in terms of its pricing. It also appears to be conflicting because on the one hand, it pleads for the recovery of costs, but on the other hand, it applies for pricing which is based on a completely floating index. So we find it difficult to marry those two. Chair, I would like to move on to the FY23 application in particular. Now, what NERSA is essentially contemplating here, or need to contemplate, is an amendment to the 2021 decision. It comes down to a retrospective application on a formula that Sasol has conjured up that simply does not exist in terms of that 2021 decision. Now, this, of course, creates certain problems for the regulator, which we will set out in terms of certain points on the legal side and certain points on the economic side. So our colleagues will touch on that. The first principle on the legal side that we need to consider here, of course, is the functus officio principle. Now, this simply means, as our colleague will explain in a little bit more detail, that once the regulator has made a decision, it cannot revoke that decision. It's a final decision. And what Sasol is applying for here is a completely different basis for applying a methodology and a maximum price. Of course, that is closely linked to the eau de Craal principle. In this instance, the eau de Craal principle simply says that a decision by a regulator can only be revoked by another court or set aside by another court. That, of course, is closely linked to the High Court application that is currently being reviewed, that you also referred to earlier on. The retrospectivity, the theme that is coming through in Sasol's application, we simply believe that there is no grounds for that. And it's very difficult to find a place for any retrospective application of a new price. NERSA's powers in terms of the Gas Act, we will also touch on that. Another principle that needs to be considered is the lis alibi pendens principle, where NERSA simply cannot consider an amendment to its 2021 decision whilst another court, or the High Court in this instance, is also reviewing the matter. We don't see any way, there is no mechanism for any particular clawback on the GE side, on the gas energy side of the pricing regime that NERSA looks into on a regular basis. And lastly, we will touch on the fact that there's no excessive pricing mandate in terms of the Competition Act for NERSA. On the economic side, Chair, what Sasol is applying for simply benefits Sasol at this point. I mean, they're applying for a 75% price increase for 1 year and then reverting to something completely different in the following year. We find that, of course, strange and perhaps even irrational and opportunistic. There's an opaque price basis with very little reference to the methodology. We don't see any reference to true costs in any of these documents that has been submitted, and that, of course, needs to be considered by the regulator at all times. The result of this, of course, as we'll indicate, massively increased profits, and then, of course, there's no evidence really that supports the alternative value dilution conception. Chair, with this in mind, we will briefly then touch on the legal side first, with regards to the FY23 application, and then we will touch on certain of the economic details. And I would like to invite my colleague, Lebo Baladi, to take us further from this point. Thank you.
Thank you for this opportunity, Madam Chair and members of the panel. Madam Chair, I think importantly is that IGUA is here to assist NERSA in making the appropriate decision. And in doing so, it's to ensure that NERSA makes this decision within the right legal framework. And so as Jaco Human has indicated, that we do raise a number of legal principles that we ask NERSA to consider in making its decision, considering the bizarreness that we find ourselves in respect of the FY 2023 application, which we submit is in respect of a decision that's already been taken in 2021. And so, as Mr. Human indicated, we've raised the legal ground of functus officio to say, as NERSA, you've taken the 2021 decision. You, as an administrative body, had a role. You took that role, you made the decision, and so the decision stands. And rightly, Madam Chair, you indicated earlier in asking questions to Sasol to say, but what do we do since we've made the decision? How can you now bring a FY 2023 application when that decision has been taken? Secondly, which we'll touch on to the second principle, which is the audit clause principle, is that decision currently stands. And so until a court sets it aside, that is the decision. And so the methodology that was determined in 2021 is the methodology that exists. And so for Sasol to now come and say, well, you can adjust this methodology and you can, figure out something new. Well, that's still subject to the court's discretion on whether the existing methodology is worth setting aside or not. And so that's the first principle that I submit, is to say, as NERSA, please consider the fact that you've made the decision and that decision is final. And as an administrator, you cannot go back to it unless you agree with the party to, then if the party agrees to say, we will revoke our rights in respect of that decision. But Sasol's not the only party to this. IGUA is affected by this decision. There's direct external legal effect. And so we say in that respect, on functus officio principle, NERSA, consider the fact that your job is done. On the audit crawl, I won't be long on this, is we all know, until it's set aside, the decision stands. And so we ask NERSA to take that into account going forward. I'd now like to jump onto the third point. Now, this is the presumption against retrospectivity. And this is a common law principle. Now, we all know that any decision that is taken cannot apply backwards unless the law allows that decision to apply backwards. And the reason is we all need certainty. So the 2021 decision was taken, and it's the subject of litigation, and it's currently sitting in the courts. And so what we're saying is there is no basis for Sasol to now come and say, well, let's go back and try and make a new, and try and apply for a new price on a new methodology and then apply it retrospectively. You can't do that. There is no provision in the Gas Act that allows that to happen. And again, Madam Chair, it's to go to the fact that we need certainty. And so unless the law is clear about retrospectivity in respect of the methodology and the maximum price charged, we can't then assume that one can then just read their own wording into the Act and apply for an amendment to the methodology retrospectively. And so that point we say we disagree with Sasol, and we say that NERSA needs to consider the fact that there is no provision in the Gas Act for retrospectivity. Now, on to the fourth point. Again, it ties in with what I've just said. Madam Chair, we're not here to tell NERSA what to do. We're just here to say, NERSA, please consider the powers you have, consider what you can and can't do. Now, as you'll see in the slide, we've set out NERSA's grounds in 21(1)(p). And Madam Chair, you referred to this earlier in questioning Sasol. It's important to ensure that you as the regulator may impose conditions for the licensee, but it does not mean that as the regulator, you can go back and amend a decision that's already been taken. Again, Madam Chair, this relates to the fact that as IGUA members and as members of the public who are affected by decisions of NERSA, we need certainty as to what that decision means. And so varying such a decision or amending it where there isn't the power to do so creates uncertainty. And so we just sought to remind the regulator, or at least inform the regulator, that when you, whatever decision you make post this, consider the fact that your powers are confined to the Act. And so this also leads to the next point that I wish to discuss. Now, again, this is the whole process of lis alibi pendens. We've got, should NERSA decide to approve this proposed price by Sasol on the new methodology. Now, that in and of itself falls back into it's effectively the 2023 period, the 2022 to 2023 period. This is the same period and this is the same decision that's already before the High Court. We can't now have a process where another decision is taken and we're litigating on the same principle. Granted, this decision and the review was argued on 30 and 31 May 2023, and the decision is pending. And so we just asked to give the courts their chance to make a decision and then consider what the implications of that decision are. And so then we move on to the next point. Now, this is a very critical point. And Madam Chair, it's critical because the consultation document considers the possibility for Sasol to claw back whatever it feels it could have earned relative to what the price was, what the price is currently, and what it says the price should be. But I think what's important here is to distinguish between the GE price and the trading price and the trading cost. These are two distinct things. And if I can just read out the paragraph from the Constitutional Court, because I think that makes it clear that these are two distinct things, so as not to conflate those two. And paragraph 16 of the Constitutional Court decision in the GUG matter. And Madam Chair, you'll know that these issues are always the subject of litigation. And part of the reason is that when these decisions are made, we just need certainty. We need to be clear on exactly what is being regulated. And so the Concord makes it clear. It says the pass-through approach requires an application to justify the proposed price for gas on a basis of a cost-based price buildup, including at least cost of procured or produced gas and any transportation or regasification costs. The transmission and distribution tariffs and the trading margin determined under this methodology would be added to the maximum energy price. So that tells you there's a distinction between the molecule price and the trading costs. And what we're saying is where the consultation document talks about a potential clawback, it cannot be, it has to be clear that that clawback is in respect of the molecule price and not all the molecule price and costs together. It's important to make that distinction, because to conflate the two would be disastrous should we end up in a position where a court or you as a body decide that Sasol is entitled to some sort of clawback. Again, we don't believe that that should be the case, but we also ask that in drafting these consultation documents, in putting together NERSA's thoughts on what it thinks the way forward should be, or what it asks the market the way forward should be, we just ask that clarity be given to points like this, where one can ensure that there's a distinction between the acquisition cost of the molecule and the trading cost. And then I'll go on to the final point, which is also dealt with in the 2024 submission. And if I may go to the next two slides, to slide 13, please. Now, Madam Chair, you raised earlier the point about the fact that NERSA has to ensure that where there is a monopolist, NERSA has to ensure that whatever the regulated price that it has jurisdiction over, such a price is done having mimicked a competitive landscape. Now, it's common cause that Sasol is a dominant supplier of gas in South Africa. And so as a result of that, NERSA rightly has taken the role to ensure that it can consider what the competitive landscape is. And in that provision of the Act, it refers to the Competition Act. However, as you would know, Madam Chair, there are two distinct acts. There's the Competition Act, there's the Gas Act, and there is also a memorandum of understanding between the Competition Commission and NERSA. And so what took us by surprise in this consultation paper is the fact that NERSA indicates its position that it feels that the 82 Rand 88 price per gigajoule is not excessive. We say that determination lies within the purview of the Competition Commission and the Competition Tribunal. As you'll see in the slide, we make reference to cases, and in particular, there's an SCA decision in Premier Foods versus Monoim and others, where the court makes it clear that the Competition Tribunal and the Competition Commission have exclusive jurisdiction. And so what we seek to highlight to NERSA and what we ask NERSA to consider is that when it makes determinations, or at least it indicates that a price is not excessive based on competition law principles, well, unfortunately, in doing so, one, NERSA is not empowered to make those determinations under the Competition Act, because it has its own powers under the Gas Act, which indicate that if a gas producer breaches the Gas Act, it has ways in which it will deal with that party. And in doing so, it has its powers to engage. But where now NERSA crosses over into the Competition Act, it then conflates two different statutes, and it then seeks to undermine what the Competition Act in and of itself has the power to do. Madam Chair, you'll be aware there is litigation before the Competition Appeal Court, which is being dealt with. And part of the questions that arise there are regarding the jurisdiction of NERSA and the jurisdiction of the competition authorities. On top of that, there is an interim interdict currently that the tribunal has decided on in respect of a prima facie finding that Sasol's prices are excessive. And so, Madam Chair, what I ask is that NERSA consider its role in what it's able to do and what the competition authorities are able to do. And Madam Chair, this also goes to the point which was also dealt with earlier by you and your panel members regarding Sasol's contractual obligations to supply. And these are things that we as IGUA feel that's what NERSA is mandated to do. It's mandated to ensure that Sasol fulfills its obligation under the Gas Act and fulfills its obligation under the regulatory framework that gave birth to the Gas Act. And so on that light, my lady, I say, we ask that NERSA take into account these grounds of objection. And in whatever decision NERSA decides to take, we ask it to ensure that the decision that it takes is legally compliant and considers these views. And so, my lady, I do not wish to belabor any of these points, and I think our slides are very clear. But to the extent that you wish for further elucidation, we've got our submissions and we're willing to supplement. I will now hand over to my colleague, Simon Lee, who will then engage you in the economic analysis.
Thanks very much, Lebo, and thanks very much, Madam Chair. I don't intend to take too much of your time. I just wanted to run through some of the key economic points here. But first, I wanted to pause just to recap on the methodologies underlying Sasol Gas's application for the 2023 financial year. And what we understand from NERSA's consultation document is that Sasol Gas is seeking to apply for a maximum price of around 120 Rand per gigajoule. What we've learned today is that actually now that's been revised and that's now 107 Rand per gigajoule. But we understand that this price is the result of the weighted average of the outcomes stemming from NERSA's cost-plus methodology, and then what Sasol Gas calls its alternative value dilution compensation methodology. And Jaco, if I could ask you to go to the next slide. Now, in our view, each of these components is flawed. And here I just wanted to quickly run through the main reasons why we take this view. The first is that, in respect of NERSA's cost-plus methodology, one would expect a cost-plus approach to entail an examination of the actual costs and the actual risks associated with the production and the supply of the gas molecule, and also to entail a determination of the return that would be required to compensate the firm in question for the risks that it assumes. But NERSA's cost-plus methodology does not do this. In other words, it does not reflect a proper build-up of the actual costs and the actual risks associated with the production and the supply of the gas molecule. And we say this because the cost component of the methodology is simply Sasol Gas's acquisition cost, which we understand from NERSA's consultation document, as well as the discussions that have taken place today, is simply based on the prices of other fuels, in particular international prices for oil and international prices for diesel. Similarly, the plus component of the methodology does not entail an examination of the actual level of profit that would be required to compensate the relevant producing and supplying entities for the risks that they take on. Instead, it's based on the profits of foreign energy firms operating in different and disconnected contexts. And what this means is that, in many ways, NERSA's cost-plus methodology collapses to another foreign benchmarking approach that is vulnerable to arbitrary shifts in foreign conditions. And a key implication of this is that if the true economic costs and risks associated with the production of and supply of the gas molecule were to change, this may not be reflected in changes in the maximum gas price as determined by the cost-plus methodology. Equally, changes in the maximum price, as determined by the cost-plus methodology, may not be reflective of actual changes in the true underlying costs and risks. And this is because the acquisition cost of Sasol Gas is ultimately arbitrary and is ultimately unilaterally decided. And we say that the only way that these two things might align would be out of pure coincidence. And importantly, we also note here that Sasol Gas seems to share these views, in the sense that it too appears to be of the opinion that a fatal shortcoming of NERSA's cost-plus methodology is that it does not account for the actual costs and the actual risks borne by the relevant gas producing and supplying entities in South Africa. What this means is that through its cost-plus approach, NERSA has no way of telling whether it will be over or undercompensating Sasol Gas. But what does the available information tell us about this? Well, it suggests that the maximum price generated by NERSA's cost-plus methodology would be likely to overcompensate Sasol Gas and would allow it to increase its accounting margins both above historical levels and above the EBITDA margin used as a benchmark in NERSA's cost-plus methodology. And I plan on revisiting this a bit later in the presentation in the second part. And Chair, I also just wanted to note that for convenience, what we've done here is we've listed the relevant paragraph references to IGWAS's recent written submissions, which address these topics in a bit more detail. Yaku, if I could ask you to go to the next slide, please. Now, the second component of the maximum price for which Sasol Gas applies for the 2023 financial year is based on what Sasol calls an alternative value dilution compensation methodology, which is essentially designed to compensate Sasol Gas for its claimed opportunity costs. Now, IGWAS's recent written submissions to NERSA outline its views regarding the conceptual flaws in this approach. And Chair, I don't plan on going through those points in detail now, but again, for convenience, we've included the relevant paragraph references to IGWAS's recent written submissions where the points are fleshed out in a bit more detail. But one thing we did wish to highlight here is that it's very difficult to comment on the alternative value dilution compensation methodology put forward by Sasol Gas because of how opaque it is. And yes, we've heard a little bit more details today for the first time, but ultimately we think that there are still some significant question marks. And notably, NERSA agrees with this, it appears, that Sasol Gas has not provided sufficient information to test the veracity of its claims around this issue. And because of this, in our view, it makes very good sense that NERSA is planning to request further information from Sasol Gas to properly interrogate its claims around opportunity costs and alternative value. And again, we've learned for the first time today that Sasol Gas may have already provided such information to NERSA, but we have yet to see any evidence of that. However, here we should also flag that this raises the question of why NERSA has not sought to do the same thing in respect of the costs associated with the production and the supply of the gas molecule. Instead, it appears that NERSA chooses to take Sasol Gas's acquisition cost at face value, even though, as we understand it, the acquisition cost is determined by factors that are unrelated to the true upstream economic costs and risks. So, with all of this in mind, in our view, there are good economic reasons to reject Sasol Gas's application for the 2023 financial year. Indeed, and as I'm going to come to in the second part of this presentation, a new price of around 120 Rand per gigajoule or even 107 Rand per gigajoule for FY 2023 would push Sasol Gas's accounting profits up far higher than what it has earned in the preceding years. Thank you, Chair. That brings me to the end of the first part of my presentation. I'll revisit some of these ideas in the second part where we deal with the FY 2024 application.
Chair, thank you very much. We would like to proceed then to the next part of our presentation, which then deals with the FY 24 application. If you just bear with me a second, I'm just trying to move these slides along.
As you're trying to find the 2024 presentation, may you please send to Mr. Eliezer Dlamini the copy of your presentation, Mr. Human, please?
Gladly, we'll gladly do that, ma'am.
Thank you very much.
Chair, then moving on to the FY24 application, we'll follow the same format. We will cover some opening remarks, and then we'll deal with this from a legal perspective and also an economic perspective. Now, I think what is a key theme in this particular application is that it would appear that NERSA incorrectly sort of conflates its role as a regulator versus that of the Competition Commission, and we'll certainly expand on that in more detail. We do believe that NERSA has no power to investigate whether Sasol Gas has indeed engaged in excessive pricing under the Competitions Act. And of course, around the obligation to supply, the commitment, the points that we've raised earlier in the conversation, we believe that Sasol Gas cannot privilege its own related undertakings over other customers due to non-discrimination obligation in the Gas Act. And this is certainly a theme that is now becoming more and more apparent within the regulatory narrative. On the economic side, Chair, what we see here is that this methodology, at least the third methodology, as my colleague has pointed out earlier, is simply not based on Sasol's costs nor the margins. Instead, it is based on some internal acquisition cost and of course the margins earned by proxy companies abroad. The second point here under the economic side is that every methodology that we've seen, from the first methodology 10 years ago to even the 2021 decision, every time leads to an increased profit margin by Sasol. And that would also refer to the third methodology that has recently been adopted. We certainly see within the application and the consultation documents that there's unfounded criticism of the true cost-plus approach. By Sasol, there's a lack of any reference and transparency to Sasol's true cost or financial performance. We haven't seen any evidence in terms of substantiating these claims by Sasol Gas. And then, of course, Sasol Gas's application is contradictory as it argues for cost-based methodology on the one hand, pleading for its cost to be recovered, and on the other hand, a global indexing. And then we'll cover very briefly the additional topics around the UAG rationality and the frequency, which was also discussed earlier. Chair, at this point, let me hand over to my colleague Lebogang.
Madam Chair, again, these submissions are similar to what I'd indicated in the FY 2023. And again, similarly, they apply to the FY 2024 because we must not conflate NERSA's role and the Competition Commission role. I think one point I will add, in addition to what I indicated in 2023, is the Telkom case, which sets out the fact that, Section 3 of the Competition Act applies where there's concurrent jurisdiction. And so it's not to say that one takes away NERSA's power, nor does one take away NERSA's ability to consult with the Competition Commission to come to a determination. But importantly is that each test that each regulator has is nuanced and is for that special regulator. And again, I think it's important that considering Sasol's application currently and what you've heard from Sasol regarding the possibility of not honoring its contract and not supplying customers such as members of IGUA, that is regulated by the framework, it's regulated by the Gas Act, and that's where we submit NERSA ought to place its focus on. And so, Madam Chair, in respect of our submissions on the legal points in the FY 2024 document, those are our primary submissions, and so I will hand over to my colleague, Simon.
Thanks very much, everyone. Thank you again, Madam Chair. Now, we understand from NERSA's consultation document that Sasol Gas has applied for a maximum price of around 78 Rand per gigajoule for the 2024 financial year, and that is based on NERSA's cost-plus methodology. But as I covered in the first part of the presentation, in our view, that cost-plus methodology is flawed. But then this obviously leaves the question of what is the right approach to take? Well, IGUASA has consistently submitted that suppliers of natural gas should be properly compensated for their prudently incurred costs and should be rewarded with a return that is commensurate with risk. At no point has IGUASA raised a view that the maximum price should be so low such that the relevant gas producing and supplying entities would no longer have an incentive to continue producing and supplying natural gas. However, at the same time, IGUASA has consistently submitted that suppliers should not be overcompensated in such a way that they earn profits that go beyond this level. So with all of this in mind, we say that the only way for this to be achieved is through a proper application of a cost-based approach, which entails looking at the true economic costs and risks associated with the production and supply of the gas molecule. And again, what does the available empirical information tell us about this? Well, it suggests that a price capable of doing this is likely to lie below the maximum price generated by NERSA's cost-plus methodology for the 2024 financial year. In other words, the empirical evidence available in the public domain suggests that a maximum price of 78 Rand per gigajoule would be likely to overcompensate Sasol Gas and would likely result in higher profits for it. And Jaco, can I ask you to go to the next slide, please? And Madam Chair, here again, we would refer NERSA to the relevant parts of IGWASA's recent written submissions for more details on this. But on this slide, what we try to do is illustrate how the maximum price for the 2024 financial year would be expected to impact Sasol Gas's EBITDA margins, again, based on information that is available in the public domain. And this chart actually shows us a few things. The first thing it shows us is that Sasol Gas earned an EBITDA margin in FY 2023 that was marginally higher than what was earned in FY 2022. And this, we feel, is inconsistent with the idea that Sasol Gas somehow incurred significant losses in the last financial year. Second, the chart shows us that if Sasol Gas were permitted to retroactively charge a price as high as 120 Rand per gigajoule for the 2023 financial year, as contemplated in the 2023 application, Sasol Gas's EBITDA margin for that year would increase significantly, far above the level seen in preceding years. Of course, we've learned today that Sasol Gas for 2023 is not applying for 120 Rand, it's applying for 107 Rand, but our conclusions would remain directionally the same. The third thing that the chart shows us is that if Sasol Gas were to charge up to the maximum price of 78 Rand per gigajoule in financial year 2024, its EBITDA margin would likely increase relative to that earned in FY 2023. Fourth, the chart shows us that if Sasol Gas were to charge up to the maximum price of 78 Rand per gigajoule for FY 2024, it would likely also achieve an EBITDA margin that is far higher than the EBITDA margin used in NERSA's cost-plus methodology. And finally, the chart shows us that in order for Sasol Gas to achieve an EBITDA margin of 31.5%, which of course is the benchmark EBITDA margin underpinning NERSA's cost-plus methodology, it would likely be required to charge a volume-weighted average price of no more than a price in the region of around 39 Rand per gigajoule. And here again, Madam Chair, we'd refer NERSA to IGWASA's written submissions, which contain the details around these calculations as well as the assumptions that have been adopted. Thanks, Jaco. Can I ask you to go to the next slide? Now, the main issue that Sasol Gas takes with NERSA's cost-plus methodology is that it produces a maximum price that is too low. That is, a price that would not provide sufficient revenues to allow the relevant producing and supplying entities to be adequately compensated for their costs and risks, and in particular the costs and risks that would be necessary to realize further natural gas supplies into the future. And because of this, Sasol Gas claims that the relevant producing entities will be forced to wind down investments in further gas supplies. Now, this makes sense as a matter of economic principle. If a price is too low to compensate a supplier for its economic costs and risks, this would naturally be expected to lead to a situation where supply is wound down or stopped altogether. However, and importantly, we have seen no attempt by Sasol Gas to quantify its costs and risks to in turn demonstrate that the maximum price generated by NERSA's cost-plus methodology is not capable of adequately compensating the relevant entities for their costs and risks. In other words, there's no way to verify whether the higher price for which Sasol Gas advocates would be justified by or would be commensurate with the true underlying economic costs and risks associated with the production and the supply of the gas molecule. In fact, as we've already discussed, the empirical evidence available in the public domain suggests the very opposite, namely that the maximum gas price generated by NERSA's cost-plus methodology would be likely to overcompensate Sasol. Nevertheless, recall that Sasol Gas identifies the main issue with NERSA's cost-plus methodology as being that it does not consider the actual costs and the actual risks to which the relevant producing and supplying entities are subject. But we find this odd because it points to an obvious solution, which is to adopt a proper cost-based approach that evaluates those costs and risks. And although Sasol Gas appears to take issue with this, we've seen no robust basis to expect that a proper cost-based approach would stifle investments, discourage new entry, or undermine efficiency incentives. Thanks, Jaco. Can I ask you to go to the next slide? Now, because Sasol Gas rejects NERSA's cost-plus approach, it proposes two alternatives in its application for FY 2024. We've already discussed the alternative value dilution compensation approach, and we again refer NERSA to the relevant parts of IGWAS's recent written submissions for more details on that score. But the second alternative proposed by Sasol Gas is to revert to the previous international benchmarking methodology. And as has been previously ventilated in this and other forums, there are significant issues with the previous international benchmarking approach. And because those issues have been covered before, I'm not going to go into detail here. But there are two things that I do wish to highlight. First, NERSA agrees that there's no place for the previous international benchmarking approach. But then this raises the question of why NERSA has now come up with a cost-plus methodology that is also effectively tied to international benchmarks, both in terms of the cost component and in terms of the plus component. The second point I wish to highlight is that it's surprising that Sasol Gas rejects NERSA's cost-plus approach on the basis that it does not consider the actual costs and the actual risks of the relevant gas producing and supplying entities, while at the same time Sasol Gas appears to support an international benchmarking approach that does precisely the same thing. In our view, this represents a fundamental internal inconsistency in Sasol Gas's application. Thanks, Jaco. Can I ask you to go to the next slide? And finally, Chair, there are a few other topics that we've not sought to cover here. Oh, sorry, Jaco, I think it's the next slide. There you go. So finally, Chair, there are a few other topics that we've not sought to cover here today in this presentation, but they are nonetheless covered in IGWAS's recent written submissions. And again, for convenience, we've included the relevant paragraph references here. Thank you for your time, Chair. That brings me to the end of my part of the presentation.
All right, thank you very much. Jaco, any final submission from your side?
Thank you, Chair. Just in closing, just some high-level remarks. So if you consider Sasol's FY23 application, we have the view that there's technically no resemblance of what Sasol Gas applies for and the applicable maximum pricing methodology, being the third methodology that we referred to. So on top of that, NERSA, in our view, is powerless to make legally make any retrospective decisions. And then on the basis or the mechanism on the clawback side of things, we also hold the view that the clawback that is being inferred in terms of the trading cost, there's simply no reference to that or mathematical function to claw back anything that's related to the GE side of the gas supply chain or the regulatory regime. So in our view, there's simply no mathematical function in which the GE price for clawback can actually be considered. It's two completely different regulatory regimes as per NERSA's own methodologies. We certainly believe, turning to the FY24 application, it still fails to rein in monopoly profits. Sasol appears to be making good money, 60% EBITDA margin on their gas business. That needs to be looked at in terms of NERSA's own proxy companies that earn typically 31.5% EBITDA margins. And we fail to see the connection in that space. Sasol's claims of alternative value compensation, additional cost recovery, requirements for price to ensure gas supply remain simply claims with no substantiation. Sasol has not approached the market with any information in this regard. Constrained supplies generally what happens if supplies are constrained, they usually substantiate these cost and price projections with customers. So not Sasol, whether it's OPEX or CAPEX in this regard. Typically what happens in the world of commodity shortages, if there's a single supplier, they would approach customers and basically sit and explain what needs to be done and what are the benefits to be achieved. We haven't seen anything of that nature. Lastly, Chair, few points. We certainly have a view that after 10 years, NERSA still ignores Sasol's true cost and profits. NERSA's decisions does not rein in Sasol's monopoly profits. Rather, it allows Sasol to make even more money every time. NERSA has never provided any detailed analysis of Sasol's financial performance or cost and the impact of its price decisions thereon. Sasol for FY23 improved its profit margins in its gas business, and that is at a flat price. Yet Sasol asked for a 75% increase for FY23. At 123, we understand it's now less. Sasol would earn an additional 3.2 billion rand profit. EBITDA increases up to 80%. For what? Why does NERSA allow margins for Sasol at 60% EBITDA, but yet on its own proxy companies, it elects 31.5% as reasonable returns? NERSA certainly has a healthy obsession with cost, but it's elsewhere in the NERSA machinery. This holds true, of course, everywhere else in NERSA where it's supposed to make pricing decisions on trading, transmission, electricity infrastructure, petroleum pipeline storage. Everywhere else we see a cost build-up approach, but strangely enough, not in the gas energy space. The consequences of these decisions basically resides in the economy. NERSA continues to expose itself
We've lost you, Jaco. Maybe someone can inform Mr. Human that he's frozen and we are unable to hear him.
Madam Chair, I'll do that and inform him.
Okay.
Madam Chair, I think those were pretty much our submissions as IGUA. I just know that Mr. Human is having issues in connecting again. But again, we say that we are here to answer your questions. We're here to assist NERSA, and we're here to file anything that NERSA requires for us to file in supplementation of already existing submissions.
Okay, thank you very much. If we can have a piece of paper and a pen, so that in case there are questions from the members of the panel and some questions that may come from the members of the public that are in attendance. Members, I would like to open up the presentation for any comments, any questions of clarity from IGUASA. The questions of clarity for IGUASA? By show of hands, members. Okay, all right. Maybe, Mr. Mkiza, you can start. Can go ahead with your questions.
Yes, thanks, Chairperson, and thanks to IGUASA for the presentation. Much appreciated. I'd just like to understand. I've got just two questions actually. One is, in your view, are we regulating Sasol here as an entity or an industry which happen to have Sasol as a dominant player? And the approach then when it comes to either way. And then two, yes, Section 8(1) of the Competition Act, number 89 of 1998, it does prohibit a dominant player from charging its customers a price that is excessive. Now, when you look at the regulations emanating from the regulations made under the Gas Act 48 of 2001, it then that regulation 4, it says that the licensee must recover all efficient and prudent incurred investment and operation cost, and also make a profit commensurate with risk. In your view, would that kind of a price, a maximum price, if really following this path, be still deemed excessive? Would you expect really coming from a regulator to still have an excessive price? So wouldn't testing that as having that as an additional test in terms of the setting of or the approval of that price be improper? Not talking about having a final say in terms of the determination whether something is excessive or not at the end of the day, sitting with the Competition Commission. I'll just like to get your views around it, because really for me it would be absurd to have a price that is regulated, but then at the end of the day still gets deemed excessive if really everything is done accordingly. Just your view on that one. Thank you.
Member Mkhize, thank you for that question. Madam Chair, you're on mute.
Sorry, I'm asking if I can still be able to direct in terms of the questions. I'm asking the members at this stage after your presentation. So I would like members to come in and ask questions first. And I requested that if you could kindly take down the questions, and then you will respond to all the questions once members have asked the questions. All right, so first it was Mr. Mkhize, and there are some questions also that are coming from Mr. Mkhize, and there are some questions. Ms. Kruger, if you can please switch off your mic. Right, thank you. Okay, I would like to start off with the question that, or the issue that was raised regarding excessive pricing. I would like to understand maybe the basis of the assertion that NERSA does not have powers on excessive pricing. Maybe you're not aware in terms of the Gas Act. NERSA in this case, and in terms of other jurisdictions as well, for sector regulation. NERSA has been granted both ex-ante powers in Section 21(1)(p). That's what we have, as well as ex-post powers, which is what the competition authorities have. And the ex-post powers are on Section 31 of the Gas Act. So NERSA is required as the price regulator. There's no other price regulator in South Africa for gas except NERSA. So we do price regulation. Competition authorities are not price regulators. They will never regulate the price. They can't say how the price should be determined. So that's the first thing. The second one is that in terms of Section 31, Section 31 allows NERSA or gives NERSA powers to investigate excessive pricing, so that if from the ex-ante position we picked up that there is an issue, the legislature also gave us powers, the ex-post powers, to now investigate and make determinations on excessive pricing, unreasonable pricing, or unjust pricing. That is in Section 31 of the Gas Act. And we do then, after we've made findings, Section 26 sub 1 will allows us to issue notices of non-compliance if there's a contravention. Section 26 sub 2 allows us or gives us adjudicative powers. Two things: to adjudicate whether or not indeed there's contravention. Number 2, impose an administrative penalty. So we've got all of those powers from our side. When it is different from the Commission has investigative powers, as confirmed in the 7/11 judgment by the Supreme Court of Appeal. And that has been the seminal case that has been used and confirmed in all of it hasn't changed for all the years. That's how it stands. We've got both the investigative powers, we've got economic regulatory powers, we've got adjudicative powers from our side. So I just want to understand your issue of saying that NERSA does not have the powers on excessive pricing. Where does that come from? Maybe if you can clarify that assertion. The second question that's the first question. The second question that I would like to understand relates to the issue of the clawback. Firstly, you've cited the decision of the energy regulator, decision taken in April of 2020 or 2021. Now, that decision has granted the licensee the right to adjust the price, and that decision has not yet been set aside. It remains valid, as you have also made that submission, but that decision remains valid. Now, the licensee has not exercised its right in terms of that decision, the right to adjust the price, taking into account cost that will also be impacted by inflation and any cost changes, plus other factors that may be taken into consideration. And that is the right that they have. That right has not yet been taken away from that licensee. On what basis does IGWASA indicate that a clawback cannot be done in that regard? That is the second question that I would like to understand, because that right is part of the decision that we've taken, which is still a valid decision to date. It has not been set aside by a court of law, and therefore the licensee indicated that it has lost some cost there. So what powers does the regulator have now to take away that right? We really need clarification in that regard. If the regulator has the principle of clawback to grant a cost that were not recovered. The third thing that I would like to understand is the fact that I would like to understand from IGWASA, which regulated markets have you looked at which utilize cost plus methodology to determine the market price for gas? Which markets are those? So that we can understand, because if one looks at the question of rationality, you look at whether any rational regulator elsewhere will be doing what we are doing. So if you can guide us on markets where there is a monopoly, and therefore the price of gas is regulated and is determined on the basis of cost plus. Which markets are those, so that we can be able to look into that, as we have to look into or look at competitive prices. The other issue that I'm not getting clearly here, when we talk about the price of gas here, we're talking about the price at the maximum level. Not just the actual price, where we can look at the price of this one entity and then we look at the price cost difference and say this is the actual price that the entity must charge. But here, it is the price that this entity must discount it in such a manner that will comply with regulations that stipulate 6 classes of customers. So it means that it is inherent there that the discount, that they must charge differential prices for class 1 customers, class 2, class 3, up to class 6. That also is in terms of section 22. So if the price is sitting and the cost is sitting at 50 rands or 52 rands per gigajoule, say that is the cost, and the price is 68 rands, how will this entity be able to differentiate between these classes of customers and discount? It will discount up to what point without the risk of charging prices that are below cost? of which is something that the regulator cannot encourage, because the role of regulation is not to regulate to the bone and push this entity that is providing a service to the market and the value to the market, and that entity gets out of business. And that will be bad regulation by NERSA, and also the industry will be deprived as well of access to gas. So I would like to understand the fact that it seems we don't consider the issue of the maximum versus the actual price, which the Constitutional Court clarified that the role of NERSA is not to determine the price at the minimum, at the lower bound. It used that phrase. It talked about the upper bound. And having referred to the upper bound, the Constitutional Court did not talk about NERSA must use a cost plus. It even stated at the upper bound there will be a surplus. And it didn't state the quantum of the surplus. It said that surplus, once it's determined, because you have to come to the upper bound, the surplus must be distributed equitably. The arguments that were made this morning, are those arguments in line with that guidance from the Constitutional Court? The last point, and this is in relation to what has been indicated also by the presentation from IGWASA, from the economists from IGWASA, it seems the way they say that the approach collapses into international benchmarking. It's like we compare with other market international benchmarking. I'm not aware that such an approach is illegal. In fact, the Constitutional Court stated clearly, if you look at the judgment of the Constitutional Court, it stated that international benchmarking is it's an internationally acceptable principle. And then it stated, however, if you are facing a monopolist, at least you must know the cost of the monopolist. Those are the words of the Constitutional Court. But it did not say that international benchmarking is illegal. And especially the fact that we need to come up with a competitive price. How do we come up with a competitive benchmark? So I wanted to just get that clarity, whether there's an insinuation here that international benchmarking is illegal, it must never be considered by the regulator. Where do we get that? Because even the highest court in the land indicated that it is an acceptable principle. Those are the questions. Thank you.
Thank you, Madam Chair. What I'll seek to do is to deal with the purely legal questions, and in respect of the questions pertaining to the economics, I'll hand over to Simon. I also expect Mr. Human to jump in where there isn't sufficient clarity on these points. And so what I'll first start to deal with is the question relating to the concurrency of jurisdiction between NERSA and the Competition Act. Now, Madam Chair, you rightly indicate that under the Gas Act, NERSA is allowed to determine the maximum price at which a licensee may charge for gas. Now, what we saw in the FY 2023 on that methodology, the maximum price turned out to be 273. And what you would have noticed from the submissions from IGUA, initially when the methodology was decided upon and the calculations were done and that number came up, was that that number is still subject to competition regulation. So it was up to Sasol to say, well, this is the figure that we get. What do we believe will comply with the Competition Act test for an excessive price? And so it was up to Sasol to determine a price that does not contravene that. Now, in light of that, the distinction comes where the Competition Act has a specific test for excessive pricing. And that specific test is set out in section 8.3 A to F, where its consideration is
Sorry,
that...
Mr. Paladi, why are we going to the Competition Act when we're talking about the regulation of the price that NERSA made a decision on? I just want to understand that, and hence I referred you to Section 21 as well as Section 31. I know the Competition Act, I have implemented it, and I understand the test that is applied there, and also the new Section 8.1. So I'm not understanding what question you are referring to here.
The point, it's to the question of jurisdiction and the question of the fact. Our submission is not that NERSA is not allowed to determine an excessive price. And I'll start there because I think you've pointed out where perhaps we need clarity, right? So Section 31 caters for specific circumstances where if I, as a consumer of gas, feel that the current price is excessive under the Gas Act, I will complain to NERSA and say, dear NERSA, here's a price that has been determined by the licensee. Can you investigate and determine under your powers whether that is excessive? And NERSA has its own rubric to determine what excessiveness is. At the same time, and as you indicate about the fact that, yes, at the same time, the Commission has a right to investigate under its act using its particular principles, which are different to those of NERSA, to determine whether the price is excessive. And where we raise this point about NERSA's powers and the Commission's powers in our submissions is that these are two different tests. And what we see in NERSA's papers, in NERSA's consultation document, is that it applies the competition test. And what we're saying is when one looks at cases like Manoim and cases like Telkom, those indicate, and 7-Eleven rightly so, those indicate that, yes, you have concurrent jurisdiction and you may be determining a similar concept. But if your act has particular lens in which you need to look at that conduct, then look at it under that lens. And so we're not here as a GUA to say NERSA is wrong to determine whether Sasol's price is excessive. What we're saying is the test used by NERSA to determine that is not the right test, and that test is to be determined by the competition authorities. I don't know if I'm clear on that one, Madam Chair.
No, you are very clear. You made it very clear. Yes, the test will be different in as much as the test for price discrimination will be different, applied by the competition authorities and the sector regulator in terms of what they need to achieve for the industry.
Correct, Madam Chair. And as you would recall, when Sasol in August last year, or the year before, indicated that it would increase the price to 133, NERSA issued a press release in which it stated the following, and this is where you tie in both the regulation of the Commission and the regulation of NERSA. It said, the recent unprecedented surge in international gas prices inadvertently affect the South African gas prices. In this regard, NERSA has embarked on a process of reviewing and refining the current methodology to protect the gas industry in South Africa, and a decision will be made in due course. NERSA does not expect licensees to exploit the current international gas price crisis to the detriment of consumers and the industry. Therefore, NERSA will investigate any possible unreasonable or excessive pricing cases and further collaborate with other administrative bodies that have concurrent jurisdiction on the matter. So there, NERSA was clear that what it felt Sasol had done under its own purview was to price excessively. But it said we will work with other parties where we will ensure what comes out is something that at least is compliant not only with NERSA's regulations, but is compliant with the Commission's regulation. And this ties in with Mr. Mkhize's question where he says, well, if you're saying that, NERSA can determine a price that ends up being excessive under the Competition Act, how do you manage that? What we're saying is NERSA sets a cap. And that's very clear. And a cap is saying this is the ceiling, but it's up to the player to show from the ground up what its acquisition of gas molecule cost is, what its trading of that gas molecule is, and a reasonable return. We're not saying to Sasol, don't make a profit. what we're saying is if you're going to make a profit, at least be transparent about how you make that profit. Be transparent about how you determine that price that you come to. It's not about just saying, well, what we determine as a reasonable profit is the difference between 273 and 68 rands per gigajoules. Is to say what we consider reasonable profit is something that even under the competition test would pass muster. And that's why, Madam Chair, what we also indicate is the fact that the tribunal issued an interdict based on a prima facie case that anything above 68 rand would constitute an excessive price. And so what you have there, Madam Chair, is to say at least the tribunal, even though that matter is still under investigation and the ultimate price will be determined, what the tribunal indicates to you is that at some point here, what we see is something that is beyond a reasonable return. And so that goes to the final point on the legal submissions, and it's Mr. Mkhize's question where he said, are we regulating Sasol as a dominant player or regulating the industry? I think what is important to note is that South Africa in of itself is in a very unique position. We get gas from Mozambique, and it just so happened that the manner in which we acquire this gas has its own costs and has its own unique features. And in doing so, we only have one gas supplier from Mozambique into South Africa, and that's Sasol. And so the Act envisaged that NERSA would ensure that when it determines whatever price it determines or whatever methodology, it will first ask itself, is the market competitive? Now, it's clear that Sasol's the only party. So it has to, in a sense, mimic a competitive market. And that's to the point you raised about benchmarks, which I think my colleague Simon will deal with adequately. But the important part is that we are regulating Sasol, but we're regulating Sasol in the context of what would a hypothetical competitive situation be. And so it's for NERSA to ensure that the tools it uses to determine what a competitive market is are the right tools, and those tools are reflective of another party that would be in the same position as Sasol, that would be acquiring gas at similar costs with a similar cost buildup and pricing adequately. And so those are what we submit are the important features between NERSA and Sasol in respect of regulating it when it comes to gas. And so I'll hand over to the final two questions that Madam Chair asked. I don't know if I've been clear with all three questions relating to the legal issues.
Yes, you've answered them comprehensively. Thank you very much.
I appreciate it.
Thank you. Can we then get responses on the other questions that were asked?
Thank you, Chair. I will deal with the clawback question. The question, as we understand it, was asked that the license condition or the statement that in fact the licensee is subject to a condition that allows it to claw back costs. We of course haven't seen the license conditions, but in our understanding is that in terms of NERSA's record for decision for the pricing methodology, there is, on the gas energy side, there's actually no function for any clawback mechanism. The clawback mechanism that sits in the trading cost is related to trading activities. And those are, of course, as the elements that are contained in that particular formulation, refers to OPEX, CAPEX, volume, and volume clawbacks, overs and unders. So in our view, as far as the gas energy component is concerned, there is simply no mechanism to allow for clawback. I'll make an additional point and refer to my colleague Lebogang around the retrospective decision-making powers of NERSA. And this is something that we have, of course, dealt with in our submissions. If we need to clarify that in further detail, we're happy to make certain written submissions in that regard. Chair, I would like then to deal then with the question around whether we have looked at alternative markets. The Constitutional Court simply requires us to look at the South African market. And what is prevalent here. And it's quite clear in its guidance that It is inconceivable for the regulator to set a maximum price if it cannot consider the cost base of Sasol, and that is the true cost base, not the cost of acquisition or anything like that. Sasol is an integrated entity and needs to be looked at in that manner. So we have not looked at foreign markets simply because, in our view, it is not relevant to the South African market. I will then defer to the last question around the classes of customers, the topic that you referred to, and I'll...
Maybe you didn't get the question right, Iago. The question that I've asked is, which regulated markets use cost-plus approach to determine the market price of gas at the maximum level? I just want to understand that, because if you assisted the regulator here in trying to find the competitive price as in terms of Section 21(1)(p). So I'm asking so that we can see whether the approach that we are taking, that any regulator around the world won't have taken this kind of approach or compensate the licensee differently. I just want to understand, where else in the world is the regulated market of gas uses cost plus, and where are the price levels? How do they compare with those that are used in South Africa, so that we can see whether we are rational in this approach in terms of the price levels?
We haven't looked at that, Chair. The simple reason is that it's not a requirement in terms of the regulatory and the regime in South Africa, the Gas Act, and of course the Constitutional Court judgment. The markets that are competitive in nature are very mature markets with completely different conditions. The markets for South Africa is unique, and we haven't come across a similar market to the South African market elsewhere.
Okay, no, that's your submission and also the interpretation of the High Court judgment. Thank you for that submission. You can then answer the remaining questions. Thank you.
Thank you, Chair. If I can then move on to and defer to Simon here on the topic and discussion around the classes of customers. Thanks, Simon.
Thanks, Aku, and thank you again, Madam Chair. I'm first going to start with your last question, Madam Chair. I think it was around the cost-plus methodology collapsing to an international benchmarking approach. I first want to clarify, it's certainly not my submission that international benchmarking approaches are illegal. I apologize if I gave that impression. That certainly wasn't my intention to say that or to give that submission. My point was a little bit more simple. It was simply that when we talk about NERSA's cost-plus approach, it's called a cost-plus approach, but ultimately it doesn't actually look at the actual costs and the actual risks that are incurred by the relevant supplying and producing entities. Instead, the cost component is based on acquisition costs, which we understand from NERSA's consultation document, is actually based on international prices of other fuels. The second point we make is that the plus component of the methodology is also based on the profit margins that are earned by foreign proxy firms. So in other words, instead of creating a buildup of the actual costs and risks associated with the production and supply of the gas molecule in Southern Africa, that cost-plus methodology is ultimately based on other benchmarks. Again, my submission was not that that is illegal. Again, I'm a humble economist. I couldn't pretend to make those types of submissions. But our point is rather that this is not a proper cost-based approach. And instead, it's an international benchmarking approach, which we again think, similar to the previous international benchmarking approach, is likely to be subject to arbitrary and capricious movements in foreign economic conditions that don't have anything to do with the actual economic conditions faced by Sasol Gas in South Africa, or for that matter, the upstream producing entity. So that hopefully deals with that question. Yaku then also asked me to deal with the question of classes. Again, I just want to say that I'm going to confine my answer to the economic principles. To the extent that there's any interaction with what is legally required, I'll obviously defer to the legal advisors. But basically, as a matter of economic principle, what we say is that Sasol and the relevant upstream and downstream producing and supplying entities should be afforded an opportunity to earn revenues that are sufficient to compensate them for their prudently incurred economic costs and to be rewarded with a return that's commensurate with risk. What we really care about is what are those revenues likely to be, right? The question then is, okay, how do we come up with a price? Our submission, and I think what I'd like to do, Chair, is also after this, maybe just put in writing some references to past IGWASA written submissions where we detail this, where we deal with this in more detail. But basically, the point is, as long as the volume-weighted average cost is such that the relevant producing and supplying entities are allowed to earn revenues that compensate them for their prudently incurred costs and provide a return commensurate with risk, we think that is sufficient. There's then a separate question of how we can take that volume-weighted average cost and create some kind of price differential between different customers. And I know that that will then depend on potentially a separate application based on observable differences. But I think our key submission is that the revenues need to be capped at that point, and they shouldn't go beyond that point to overcompensate the relevant producing and supplying entities. We certainly haven't seen anything to suggest that the methodology so far directly take into account those actual economic costs and risks. And therefore, in our view, the current methodology does not allow NERSA to determine what level of allowable revenues is appropriate, which then, of course, then would hinder the ability to then determine how then to differentiate the actual prices that are charged. Thank you, Chair. I hope that answers your questions.
All right, thank you very much for the question. There's just one more question from the audience. It says, given that Sasol is of the view that NERSA has jurisdiction to deal with competition issues, does NERSA have the right to request the same information which forms the subject matter of the Competition Commission's summons to Sasol? And that's where it ends. It is directed.
I suppose, Chair, that sounds like a question directed to the regulator rather than IGWASA.
Okay. No, we will then, we'll respond to it if they want specific details. That's fine. All right. We'd like to then thank IGWASA for the presentation and all of the views that you have shared with us today during this hearing. Thank you so much. We'd like to then maybe take 10 minutes break at this point in time. When we come back, we will take a presentation from SLG, and then Sasol Gas will give Sasol Gas 5 to 10 minutes for the closing remarks, as we normally do with the applicants, so that it can provide a reply to some of the issues that were raised. If we can take a 10 minutes break and come back at 20 to 1. Sorry, at 10 to 1. It's 22 now. At 10 to 1. Thank you very much. All right. I think we are ready to resume with the hearing. We are now resuming the hearing, and we have the next presenter. The next presenter is SLG. We've got the Group CEO of SLG, Mr. MC Kyokolo. Okay. Good afternoon, Mr. Kyokolo.
Good afternoon, Madam Chair.
Good afternoon. All right. I would like to then swear you in. Do you have any objection in taking the oath?
No, I do not, Madam Chair.
All right. Thank you. May you please raise your right hand? Do you solemnly declare that the evidence you are going to give to this panel is the truth and the whole truth?
Yes, I do.
Thank you very much. May you please state your name and your designation at SLG?
My name is Mzi Kyokolo, and I'm the CEO of SLG.
All right. Thank you very much. You may start with your presentation.
Thank you, Madam Chair. Madam Chair, as we share the presentation, which I hope is now on the screen for everyone to refer to, I just would like to give a bit of a intro. Is that SLG has written a substantive response to the applications, and our presentation really seeks to echo principal aspects that effectively consolidate our views that we have shared with the regulator in our submission. And in doing so, Madam Chair, we will really touch on the 4 key salient points of our submission, which really deal with Sasol Gas's views and position as far as the 5% discount for the reseller is concerned. What we also deem as a misconception about the recovery of investment costs upstream, and address Sasol's views on the impact, Sasol's impact on the long-term gas supply market sustainability, and of course, share a view we have with regards to the technical, some technical aspects of the adjustment mechanism that Sasol proposes and its market impact. So, Madam Chair, in doing so, on the first point, I think it is important to highlight that we have noted, perhaps with concern, I must add, that Sasol, in how it's formulated its application, it has sought to depart from the mechanism, the methodology and the mechanisms that the methodology has. And Sasol seeks to introduce new elements of the methodology that we believe had a place and time to have been done, and to try and do so now is a little bit late in the game. And for all intents and purposes, I think our colleagues at Iguasa have also very elegantly put that there is an approved methodology which just needs to be applied. And so we so believe that any departure from the methodology is certainly a function or a subject of court reviews of the methodology as a whole, not something that is to be introduced during an application which just seeks to apply the provisions of a methodology. So that being the overarching point, we will then get into a bit of detail in terms of our principal position on the 4 salient points that we highlighted. I must, however, emphasize, Madam Chair, that given that the position that was published by Sasol with regards to the 5% discount that was coded in the methodology to be offered to resellers, given that Sasol has reviewed their position in that regard, it has made this a moot point. It does, however, leave room for us to echo the very well argued reasons as to why it is important to recognize a reseller's market as a different market from an end user market. And as such, the coding of the minimum of 5% discount for resellers was really by and large meant to further the objects of the Act and, of course, the mandate of the regulator, which is to ensure that there is an orderly development of the gas industry, but above that, something that was to assist in fostering a competitive gas market. And again, something we've seen of late, which is the conduct of Sasol of charging the same price to the market as a whole, was something that a discount of this nature sought to at least arrest to some limited extent. And as such, I must say, maybe with relief, but still leaving the point on the table, we appreciate that there's a change in the application of the 5% discount. However, we still want to hold on to the point that a discount of 5% on its own is still falling short of the desired position of a differentiated pricing methodology that is to be applied to resellers of gas. And as we believe that is the only real mechanism that will foster and enable a competitive environment. The second point, in principle, I'd like to perhaps touch on pertains to this Sasol's position with regards to gas supply investments. And we'll start that by saying Sasol's claim that the methodology won't recover costs for exploration and production sort of departs again from the basic principle of what the regulatory framework that we have is, because the current regulatory framework regulates licensees, and it has provisions as to how those licenses are regulated. It further goes as far as having an allowance to allow licensees to recover prudently incurred costs and reward risk that the licensees have taken. Now, the critical point to make here is that the licensee in question is Sasol Gas. And Sasol Gas is a trader of natural gas and MRG in South Africa. And the introduction, therefore, of upstream costs, which by and large are costs borne by the group of companies within Sasol Limited in their various formulations, and trying, therefore, to bring that as a direct cost to the end user market in the gas trading space, we find that as an amiss position, as a matter of fact. We do, however, want to highlight one of two things. First being the fact that if this is a position that is held, it clearly creates grounds for dispute over Sasol's expectations that third parties and end users must now fund its upstream business activities. And it secondly also does not take into account the historical benefit that Sasol has had as a group. And of course, the discussions that have happened earlier have already touched on some aspects of this, because, I mean, we've had a very lengthy conversation about the alternative value of this gas, but in the same breath, it's created value in different parts of the Sasol group. And as such, the fact that most of this gas historically has been used as a feedstock for Sasol, and it has created the value that is created, can't now be a forgotten fact, and that only the extension of the fields henceforth become a burden that is placed on the external gas consumer market or reseller market. So it is worth noting, Chair, in conclusion of this point, that the market, not being blind to the fact that we're having a situation of a declining resource in Mozambique, that a position that seeks to take the market into its confidence, share the benefits, the burdens and the costs of extending the life of the resource in Mozambique, and how any investments the market itself makes in that exercise will be shared equitably. The market is open to a conversation like that, but the way it is postulated as part of a maximum price application does certainly leave quite a bit to be desired from a market point of view. Okay, the third point we would like to deals with yet again the position taken where the application is couched in a way that if the, let's call it, the desired position is not heard and adopted, then it sort of translates into a supply risk of natural gas to the market. So Sasol makes a claim, therefore, that the reliability of gas supply going into the future is now at risk. But it needs to be noted that the position of Sasol Gas, which is made on the back of previous attempts to artificially increase gas prices by considering opportunity costs instead of marginal costs, as envisaged by the Concord finding of 2019, is concerning. Secondly, the threat of security of supply, it almost feels and sounds like it's like, give me this price or else, is also a concern and postulation of a position which in itself is real, but requires a little bit more, let's call it a market friendly positioning. So at the end of the day, we're left with a question then that, you know, if a security of supply lends and seems like a reality, we're going to start seeing a shrinkage of the gas market in South Africa. Now, and yes, that will happen with larger customers that do have alternatives to go to gas. But the question that remains on the table is a shrinking external gas market where customers have rather adopted a position to go to alternative energy sources. Who does that position ultimately benefit in the current context, in the current conversations of energy supply shortages and gas shortages in particular? Here we'd like, therefore, to move on to sort of share our views with regards to the alternative value dilution compensation position that Sasol takes. And the first thing to highlight in this regard is the simple fact that Sasol has engaged itself quite substantively with the mechanism of how it has calculated and seeks to justify the value and doesn't invest as much time in convincing the market of the relevance of the position it takes or the principle in itself. So, and in the same breath, Sasol then proposes a higher price and it seeks this price as a compensation due to selling gas externally. It is therefore very curious that this particular imperative and the parity pricing becomes an issue only in the current context of low gas prices, of restriction on our gas supplies from upstream sources. And then, of course, in the new context we have experienced over the last few years of a growing customer bargaining power, where we're seeing customers having a much stronger voice and challenging the positions that we as traders are taking. And of course, the court cases that we now all know are currently in our courts. And so one has to therefore pause and ask ourselves, this current position, notwithstanding the rationale, why now? So I would conclude this point by perhaps firstly imploring Sasol to, notwithstanding what they seek to achieve, but to rather lobby for a position that is perhaps of a more accommodative framework, because this alternative value dilution concept in itself, given that it's an opaque, particularly not very transparent sort of mechanism, and notwithstanding the details that were shared with us this morning, I believe it has a very large scope of elasticity. In other words, depending on the argument being advanced, that the numbers have got no end in sight, and therefore, what then becomes the end point of that position? Furthermore, whilst being acutely aware that there's a market constraint, it is also important that that conversation also involves a clear indication as to what's in it for everyone that is now being asked to invest in securing the supply of gas in the future. And Chair, in conclusion of this point, and I think a very worthy point to make is that Sasol Gas created the so-called external market, which in itself has led to immeasurable economic benefit, both for Sasol and the South African Incorporated at large. But now, that same market is expected to compete for its existence against Sasol's greater profitability objectives and self-service position. And I think this is echoed a lot more in the proposal of the FY23 price, which yet again, if one takes a view of elegance in postulation, would say this value dilution concept perhaps, and not perhaps, absolutely fails in its convincing the market that Sasol has incurred additional costs in FY23, which the 68 Rand didn't allow it to recover. And secondly, a Sasol that comes to market and asking for it to, or the regulator, and asking the regulator to allow for a provision for it to be able to recover that cost, mechanism still to be determined, as it has been an issue of argument again today. I think that is a more reasonable position to take. But the way it is currently being postulated is certainly a very hard pill to swallow because, as we say, it seems, and the language is a compensation mechanism. It's not, everybody would want to be made whole in business if you've incurred costs you didn't foresee because your prices have been flat for whatever reason. However, this context certainly finds itself creating a very large resistance and taking away the need for us to all take a reasonable position of if Sasol Gas has indeed incurred additional costs, and therefore the mechanism of cost of acquisition cost being the relevant point of reference, shouldn't it then be allowed to recover the cost increases that it has indeed suffered? And that is, of course, something would lead for the regulator to engage and apply its mind on. And Chair, in conclusion, I would like to perhaps just highlight the technical aspect of the Sasol application, which again leaves a little bit of uncertainty in the market, and that is the fact that the details of the let's call it the indices that would drive the quarterly adjustments are pretty clear in that they are specified. What is not particularly obvious is the detail of how those come together in driving the price. In simple terms, we know the components of the formula, but we don't know the formula itself. Neither do we know the weighting of each of these components, because as we all understand, a world where, for instance, the crude oil components are a majority in the formula is a lot more unpredictable compared to a world where there is a majority component coming from the PPI elements of the indexation. So it would have been quite helpful if Sasol had taken the time or taken us yet again into its confidence to share a little bit in terms of the drivers and how they come together in driving the quarterly adjustment that are then envisaged to be applicable to the prices that Sasol Gas has applied for FY 2024. And Chair, I think at that point, I would like to conclude SLG's presentation of our submission. And thank you so much for your audience.
Thank you so much, Mr. Chokolo, for your presentation. I think it is very clear. Let me check if the colleagues have any questions of clarity to ask from SLG. Any questions of clarity, members? All right, maybe let me start. I have maybe two questions. The first question relates to the 5% that was mentioned, 5% discount that was mentioned. What is your understanding of this discount? Is it your understanding that this 5%, the way that it is proposed, it is actually a minimum, not the maximum that Sasol may consider? So, in other words, they have to consider various factors, and also for reasonableness, they need to consider the objective differences as contemplated also in Section 22. So, 5% itself is a minimum. So, what is your concern there? Is it that it appears to be a maximum in your view, such that Sasol will not charge or sort of offer something lower or something above it? That is the first question that I have. And with regards to the issue of supply, the ability to supply the market continuously, what do you suggest that it be done in the case where the only supplier to the market is stating the facts about the constraint in the current supply, which is the 2026, and secondly, that for it to be in a position to continue to serve the market, it will have to invest. And by investing, therefore, the normal way, the normal thing to consider will also be how the industry comes into play there. If the industry wishes to enjoy the gas supply, or else the company invests for itself and it has the alternative use for its gas. What is your take really on that? Is it because in that situation, should it be a situation where then the licensee decides what it wants to do, or the licensee must invest on its own, and then the price gets depressed, and the investor is not able to recover and enjoy the cost of the investment and the rewards for the investment? So, if you can clarify that, Mr. Mkhize.
Thank you very much, Chairperson, and thanks, Mr. Chokol, for the presentation. For me, it's just one issue that I've noticed being stated: the opaqueness of our methodology. We're not in the stage of reviewing of the methodology per se, but I think that it will help if you can just maybe write to us and talk to specifics in terms of how that opaqueness can be dealt with. And I think that it's also the same goes also to the QISA and others, because although we're not reviewing it, but I think it helps just to get all the relevant information that would pertain to concerns, so that later on, if being on a continuous improvement path, one will then look at those things and be able to address challenges head on. Thank you.
Thank you, Mr. Mkhize. Mr. Chokolo, may you please respond to the questions?
Thank you, Madam Chair. Madam Chair, let me start with the two questions you posed, one being about the 5% discount. So as far as alignment with regards to what the intended position regarding the 5% is concerned, SLG is fully aligned with the regulator position, which is, and this is our understanding, the 5% discount was meant and postulated and written as a minimum discount to be offered to traders, opening, therefore, the scope for the, let's call it the licensee upstream, Sasol Gas, to consider other factors that would then play a role in the ultimate conclusion of whether are they going to offer the minimum at 5%, or would they do a let's call it an extension of that to a different percentage. So that being the case, it is important to echo and highlight Sasol Gas's position that has changed between the written submission and publicized pricing mechanism, where Sasol was pretty clear that they do not agree with the 5% discount as stipulated by the regulator, to a position that they have stated this morning, where they now agree that they would offer, and this, the words, and I'm quoting them verbatim, the 5% discount. There has been no mention of it being the minimum 5% discount to traders. Neither have they echoed the position which they had in their written submission, which was that a discount should be subject to trading terms and specific conditions that apply to a particular reseller. And that did create an environment of understanding that they would consider the 5% in the context of these contractual terms and therefore come to a different number with the clear understanding that the 5% is a minimum. So if there was a seeming concern, it comes out of first Sasol's initial position, and I must say it has not necessarily been ameliorated by their most recent position, because the initial position was almost a dismissal of the 5%, and it's followed now by a confirmation that they only limiting themselves to the 5%. So if that remains the position, then SOG, and I would dare to say the other traders, remain concerned about that postulation, because our very competitiveness, actually, if one goes back historically, was more about the fact that due to the aggregated larger volumes that we're buying, we had a better price position, which enabled us to compete amongst ourselves and with Sasol Gas itself, Madam Chair. The second question, if I may, deals with the issue of supply security. And I think at a principal point, one needs to be very specific and highlight the key point, which is the current regulatory framework. Firstly, one has to almost specify that it ring fences Sasol Gas as a licensee and only regulates Sasol Gas's position in the market. I think it's important to highlight that first. Now, the Sasol Gas, who is the subject of the application and the subject of the regulation, does not produce gas upstream in Mozambique, does not explore for gas. It buys gas from such entities in Mozambique. Now, from an investor point of view, and this conversation was already had earlier, as those entities that are upstream in their business model should have made provisions for exploration costs and production costs, etc. Now, how we believe that should then translate to Sasol Gas is that, as the methodology states, Sasol Gas has acquisition costs which should be invoiced to it on its invoice, clear as to what it has paid for the gas, which cost should, in principle, have taken into account all these other upstream costs. And that should be the initial point of reference as far as the methodology is concerned. There is, and I'm not blind to this, but there is a greater investment conversation that happens within the Sasol stable of companies. And the key aspects that drive that, in other words, there is an investment framework that has been articulated. There are expected returns on particular investments. There is a position taken as to what is the return horizon. All these other aspects need to happen upstream in the relevant entities. Furthermore, as they happen, they need to look at the product in question in the full context of the value it creates in the different pockets of Sasol. And that's not only an issue that seems now that it becomes a conversation piece for the gas user market and as I said, the convenient external gas market. Because ultimately, if we're now getting burdened with a investment conversation, but we are only getting let into a snippet of what's at play, how then do we meaningfully participate in either supporting that position, because the default position therefore becomes a rejection of that position. And then in conclusion of the third question that relates to the opaqueness of the methodology, if I in any way came across as if I intimated that the methodology in itself is opaque. Certainly that wasn't the position, neither was it the intention. However, there are aspects of how Sasol interprets the methodology or seeks to, let's call it, amend its provisions that are in themselves quite opaque. One such case in point is, I mean, thankfully for the first time today, we at least were led into the calculation of how the so-called value dilution value has been arrived at. But yet again, we are competing with, let's call it, margins within the greater Sasol business, which we don't know. And that obviously departs from the fact that should we even be having that conversation in the first place? So this very limited release of data and information to drive a particular decision is amongst other things what complicates the decision or the conversation leading to any conclusive position in the first place. I hope I've handled or responded adequately, Madam Chair, but if not, I'm happy to clarify.
No, you did. Thank you very much for the responses. I think the last point from Mr. Mkhize is just to say that as we implement the methodology, if the stakeholders could submit their concerns on a continuous basis, because we want to learn from practical experience so that even when the regulator considers at some point to revise it, at least the regulator will be making an informed decision, so to speak, revising the methodology to try and deal with those aspects that may not have worked very well for the industry at large. So he's just inviting concerns that they be submitted to the energy regulator. At this point, we would like to thank Springlight's Gas, SLG for your time and for sharing your views and your contributions that you've made in this process. Thank you very much. Thank you. We now call upon the applicant, being Sasol Gas. Sasol Gas, you only have 5 to 10 minutes at the maximum, and this is not the presentation, but it is the reply to the issues that were raised and making your final remarks.
Yeah. Madam Chair, thank you for the opportunity, and I think right at the outset we would also take note of the invitation that Mr. Mkhize and yourself has put forward, that to the extent that there are comments and concerns with the existing methodology, that we can address that to the regulator in our ongoing engagements with the regulator. I think in the final instance, Madam Chair, there's 4 points that we would just like to respond to or to highlight in conclusion of the submission of our application. I think the first point that we need to consider is the context within which the maximum gas price applications are made by the applicant and has to be considered by the regulator that now has to take a decision on these maximum gas price decisions. In terms of Section 21(1)(p) of the Act, NERSA has the authority to approve maximum prices, but the only reason why that requirement for the regulation of maximum prices exists and is put at the door of NERSA to actually regulate is the fact that the gas market in South Africa currently has inadequate competition as a result of the historical structure and how the market developed over time. So the market is devoid of the adequate competition that the Gas Act talks about. And in order to address that shortcoming in the market, the Act then gives the regulator power and jurisdiction and authority to approve maximum prices into this market. And to address this absence of adequate competition. So in fulfilling that mandate, the regulator ultimately has to determine a maximum gas price that mimics the price that will apply in a competitive market, or in the latest language that the regulator uses in describing that, a adequately operating competitive market. The commodity that is supplied into this market is an internationally traded commodity, and therefore one has to bear in mind the value that this commodity ultimately has into the different markets into which it can be supplied and provided. And from that point of view, Sasol Gas remains of the view that a cost-plus approach to regulate prices in a market like this for a commodity of this nature is inappropriate, because it doesn't ultimately result in the true value of the commodity in the hands of the supplier, and therefore doesn't strike an adequate and equitable balance between the supplier and the customer in the price that is set. Ultimately, the competitive price that's required to be set in the market needs to incentivize the continued development and growth of the market, and ultimately the ideal is that that market should grow through new incumbents and new participants in the market, so that at a point in time in future you end up in a situation where adequate competition has in actual fact occurred, and the requirement for price regulation actually no longer applies. Now, it is true, and as we've dealt with earlier in the question that Mr. Gumede asked, the price that NERSA is regulating is not the price at which the producers of gas in the upstream is selling the gas. NERSA is looking at regulating the maximum price that applies in the downstream market, where the gas is supplied in our market to the end-use customers and to traders like SLG that made their presentation just before this. So while that is true, it is still important to take cognizance of the fact that ultimately, in order to foster the growth of the market and to facilitate the development of a competitive market, which are the objects of the Gas Act, which the regulator is also obliged to deal with. The incentive for investment in upstream development cannot be ignored and has to be taken into account, because not only Sasol, who is a current upstream producer or a party to a joint venture which is a producer of upstream gas, but for any other future upstream participant to sell gas into the market, either directly or through traders like ourselves or SLG or any of the other companies that hold trading licenses in South Africa. The price that can be achieved within this market in the framework of regulation by NERSA has to make it attractive and sufficiently attractive to incentivize that investment. Now, I just want to, as a second point, just clarify in response to the comment that our colleagues from IGOA made about the possibility of Sasol Gas may be misrepresenting or putting the information about upstream investment and exploration incorrectly. I just want to clarify that the figures that we quoted in our presentation earlier today with regards to investment investment over the immediate time leading up to 2023 in order to extend supply to FY26, as my colleague Ms. Brainard indicated. Those figures that were quoted in our presentation today is confined to investments in the PPA area, which is the current source of gas that is coming to South Africa. It is true that other exploration activities are afoot and that there is further investments being done, but until those investments yield economically recoverable resources of gas, obviously it's only at that point in time, if that gas comes into the South African market, that it will contribute to the acquisition cost that is to be taken into account, or if the methodology according to which the maximum gas price is determined at that time has changed and is no longer subject to a cost base, it's only at that time that that particular tranche of gas will be taken into account. Further, we also have to clarify, and I think we've already heard in the presentation from SLG that the contracts in terms of which Sasol Gas acquires the gas is long-term, commercially concluded contracts, not only with Sasol parties, but also with third-party joint venture partners. And therefore, to suggest that that acquisition cost is a purely internal cost within the Sasol value chain is incorrect, because there are other third parties involved in the sales of the gas, which ultimately represents the acquisition cost. So we just wanted to clarify that as well, Madam Chair. And then in conclusion, as we indicated in our presentation earlier today, the FY24 price that we are applying for, together with the approval of the quarterly adjustment of that price, is fully justified, and accordingly, in our view, there's no reason for NERSA not to approve that application. With regards to the FY23 application, the 2021 price decision by NERSA contains a provision which allows an adjustment of the price for the FY23 period. The method or the formula that did that adjustment with reference to the international markets as contemplated in the 2020 methodology was deemed by NERSA and found by NERSA to be inappropriate. And therefore, we are today here before NERSA asking for NERSA to approve an appropriate adjustment on the basis that we have proposed, and also to approve an appropriate recovery mechanism to allow us to recover the foregone value that has been occasioned by the fact that we continued to supply gas at the FY22 maximum price without the adjustment that the 21 decision afforded to us as the licensee. So that is our submissions, Madam Chair, and we're looking forward then to the decisions by the regulator pursuant to these applications that we've submitted.
All right. Thank you very much, Sasol. With regards to the information, remember there's information that was not provided, but it came during the question session, the information regarding costs that are not covered in terms of the submissions that you've made. So and this comes from NERSA now, since this is something that came up, requesting that does the upstream price reflect the true value of gas? You don't have to answer because this is not the stage for the presentations again, but I think it's information that they are requesting the staff so that they look into it since it came up during the response session. So does the upstream price reflect the true value of gas? So that's part of what they're asking you to submit in the next 7 days. And then the other one for Sasol to provide proof that there are other costs not covered by the price of gas or by the cost that has been submitted. So if you can provide the proof and those additional submission to clarify the points that were made during the answering session. So this is not the stage to ask questions, but we thank you for the clarification that you have provided and for the closing remarks that you have made, and we're hoping that you will then take the opportunity to provide additional information in respect of the issues that came up in the next 7 days, and other presenters as well, that where they needed to provide further clarification. If you can do so within the next 7 days, we will appreciate that. We have now come to the end of the public hearing for all the 3 applications that were submitted by Sasol Gas, and I would like to thank all the attendees, those that have attended or joined the hearing through various platforms. Also thank the staff members of the energy regulator, and I want to thank the presenters as well that took their time. But I want to also just offer my appreciation to the panel, the members of the energy regulator that are part of this hearing today, to thank you very much for the time that you have taken and asking the questions of clarity. So the hearing is now adjourned. You may disconnect from the platform. Thank you very much. Thank you. Members, we're not going to have the post-hearing, but we can just set up the date for the post-hearing. I think other members have time constraint. Can
yes,
we?
Chair, thank you.